Well, I'd be very careful of some of your software companies and a lot of what's in the ARC portfolios where you don't have profits and you may not have profits, where almost everything has to go right, yet you're paying ridiculous multiples to sales. Always be careful of paying big multiples to sales for profitless businesses.
Hi, folks. I'm absolutely delighted to welcome today's guest, Christopher Bloomstran. Chris, it's lovely to see you. Thank you so much for joining us.
Bill, it's great to be here. I mean, as much as I loved your book, in the last few weeks, knowing I was coming on your podcast, I've been listening to, I'm probably through a third of them, and they're just phenomenal conversations about not only investing, but life, and kind of true to the spirit of the book. So it's a real privilege to be with you today. Thanks.
Thank you. It's a real delight to have you on. And one of the reasons why I wanted to get you on actually is that Guy Spear said to me months ago, you need to get this guy on. He said, Chris is brilliant and he has a really interesting mind and he's really unusual. And so I had read your letters over the years. I think I'd read your letter for the last 3 years, which is an amazing thing, as we'll talk about. I mean, it's a huge thing. But it's lovely to meet you finally in person, at least virtually, remotely. And I wanted to start really by chatting with you in some depth about an extraordinary but largely unknown character who played really a transformative role in your life. This man called Robert Brookings Smith. And in your 2021 letter to your clients, you wrote, "If the world knows Benjamin Graham as the father of value investing, I hold Robert Brookings Smith as its godfather. I contend he is the only investor to have nailed 1929, 1932, and 2000 spectacularly well." And he's also just a really fascinating character personally as well. So can you tell us who Mr. Smith was and how he came to be client number one at your investment firm, Semper Augustus? And then let's get to what you learned from him.
Wow, sure. So had I not included that section in the letter, which really dawned on me I should do it, with an interview I'd done with Jim Grant. And we touched on kind of our first client and who he was. And I told a little bit of his story. Jim called me after he published it and said he thought it was his favorite interview. Well, he called me right before he published and said, the one thing you didn't do is mention his name. And I said, well, he was very private, but, we're very guarded with our clients. And I said, I'm just not in a position to tell you who he was, other than he was Semper's first client and that bit of background. And so his piece turned out so well. I thought, gosh, I mean, his story really deserved to be told. He was a remarkable man. So I called his daughter and told her what I was thinking about, what I was working on for the letter. And she loved the idea and encouraged me to do it. And so I set out to tell a little bit of his story as an investor and a human being through what I view as the main secular peaks and troughs over the past century, and kind of linked it with what Warren Buffett had likewise done at various peaks and troughs. And so I set out to succinctly try to tell the story of this great guy that was born in 1903 to a fairly wealthy family here in St. Louis. They had a brokerage business that was started in the 1800s that still exists by name today. Never got acquired. In any event, he went off to Princeton and to study, and was in the choir, but he rowed crew. He was on the football team and came back from school and joined the brokerage business in his mid-20s, early 20s, I guess. And by 1925 or so, his father had passed away, and he had moved up the ranks a little bit as a youngster. But in early 1928, he would have been about 25 years old, and he believed there was a bubble in the stock market and in the economy. And so he took all of his family's, substantial at the time, capital out of the market and invested in bills and gilts and some railroad bonds, and any clients that would follow the heat of a young broker likewise did the same. And if you know your stock market history, you'll know that the stock market peaked in the fall of 1929. And so if you go back in time and look at kind of when he sold the portfolio down, the Dow Jones would have been about 200. Well, it didn't peak until hitting 381, I believe it was, some, year and 3 quarters later. which would have been brutal. I mean, it would have been like getting out of the stock market in 1990, 7 or 1998, thinking there was a bubble and just watching things continue to skyrocket higher, especially for the outside clients. And so obviously vindicated in the end, and the Dow plunged 89%. We wound up in a depression. And he waited until the bitter end, and he waited until 1932 to put the capital back to work, and reasoned at the time that you could buy businesses like General Electric for less than the cash in the business, and kind of a genuine net of working capital. So where Ben Graham was writing security analysis, having lost an awful lot of money in the 1930s, Bob Smith was picking up just gems of assets. And would have been hard to do because, most investors and most people in the stock market had lost so much that, even if you had the wherewithal to not panic and sell on the way down, you needed to live off your portfolio. And there are a couple of great books out, but they were, the doctor class and the lawyer class professionals had clients, but the clients didn't have any money, so nobody was getting paid, and so you had to liquidate your stock portfolio. Well, if you had capital and weighed back in at very incredible discounts, that's what he did. And then
I think you said that he bought GE at the equivalent of 12 cents per share in 1932.
Yeah, by the time I got involved in the late 90s, the dividend was multiples of the cost basis. Even the quarterly dividend was multiples of the cost basis, which is kind of incredible. But that's what happens with what had been a good business over a lot of years. And GE wound up ultimately not being a great business, and we figured that out. But it was great.
An astounding thing if you think about it. Even the fact that he not only did this extraordinary thing that you mentioned in 1928, where he saw that there was trouble coming, then he gets back in 1932. But then equally astounding is that he holds something like GE for the best part of 60 years. And I think you've said, maybe it was in that 2021 letter, which was terrific, you talked about how he picked up various other great stocks along the way. I mean, he bought, I think, Merck and Dow Chemical and AT&T in maybe the 30s, and then later things like Walmart and Merck and Microsoft and Sun Microsystems. Can you talk about how he was able to hold these things for so long? Because it's not just the timing, it's the extraordinary patience of the man that's remarkable.
Well, he was Scotch. He was a little like Warren Buffett in the regard that I don't think he favored sending money to Washington, D.C. So, to the extent you had capital gains taxes, he was averse to that, and adopted what he called for years and years investment philosophy of benign neglect, which essentially it's a little like the coffee can approach, where some of your winners really wind up dominating the portfolio. I mean, by the end, by 1998, when I got involved, GE was half the business. But I also think over the course of his life, he observed some things. You had kind of a somewhat of another secular peak in 37, but that was the point where Germany was on the rise. He was actually in Germany doing some work, and had a lot of friends in Washington. The family was very well connected, and he had some very early intelligence. He and a friend of his, Ned Putzel, who wound up being an attorney in St. Louis, who wound up running the OSS, which was the intelligence arm of the military during the war. But Mr. Smith had a fair amount of intelligence that Germany was mobilizing, and he didn't trust the communications. So he got on a ship, came back to the States, met with the Pentagon, and the War Department, I guess the Pentagon at the time, and let the folks know what was happening. And then by the time the war actually broke out and Japanese invaded Pearl Harbor, he called his friends in the War Department. He was in his late 30s now at this point, or mid 30s, late 30s, and he couldn't bear to not be in the fight. And they said, Bob, we're not going to put you in the fight. You're too old. I mean, he says, no, I got to be in the fight. And so they put him in charge of a training vessel on Lake Michigan at what's still the Navy's big training facility. And ultimately, I guess he called him back and said, this is not really the fight. This is not what I signed up for. So he wound up ultimately second in command on a light carrier, the White Plains, and found himself deep in it, and was in the Battle of the Philippines when I met him for the first time, and throughout his time when he was in the office. I mean, he had pictures in his office of the Battle of Leyte Gulf, which was the major battle, the turning point of the battle, where we decimated the Japanese fleet and cut off their oil lines and supplies, and reversed the fleet couldn't get back for munitions by not having the stranglehold of the Philippines. And he was in it, and he was part of the battle, and he would tell me these stories. And he told me at a point in life, he said, Chris, it's when you get to my age, it's a bittersweet, sad thing. He says, I'm so fortunate and blessed for the relationship with you. We'd gotten to be very good friends in his last 4 or 5 years, but he said, my friends are all dead. And so he'd confide in me a lot of things. And he said, he would have nightmares throughout his lifetime about that battle in particular. It was the first time the Japanese had used a kamikaze strategy. And, he'd tell me the stories about the kamikazes dive bombing his ship. One exploded just a few feet from the ship, damaged the hull of the ship. They wound up having to take the ship back to San Diego after the battle. But another adjacent carrier was destroyed by kamikazes. It may have been a destroyer. But he had pictures of the boat sinking, and the sailors in the water. Just a harrowing thing. And so, I think scarred by that. So here he is at war, and the stock market by 1942 had just been decimated again from the 1937 recovery high. You were back to, I think, 90 on the Dow. You got down to 41 in 1932, but back up to almost 200. Then, so here he is. And surely at some level, you're in the Pacific Theater, but you're paying attention to the stock portfolio because you come from a family of money and you're in the money business. And so I think at the point, even Warren has talked about this. It's, if things looked as grim in 1942 and America wound up being what it was, and you could survive that onslaught, you just let things go. And so I think, he probably came to this philosophy of not selling things because he obviously sold things in 1928, but then wound up not selling things. And so there's a great story about Nancy, his wife, who I loved, and she was just an extraordinary woman. She liked to joke. She'd say, Chris, Bob had it pretty bad in the Pacific Theater. They would come back to port in San Diego. And so I lived at the Hotel del Coronado when he was gone. And during the day, I'd be at the beach looking at the ocean, longing for my Bob. And of course, at night, I'd be at the bar, and things were a lot worse for him than they were for me. And but he came back and wound up leading the effort to start shrinking the Reconstruction Finance Corporation. Businesses had been, couldn't get loans and couldn't get insurance contracts. The RFC had to run off. He told stories about they were selling off the military planes and ships, some for scrapping, but they had to shrink that enterprise, and he led that effort. Then eventually got into the banking world and joined Mercantile Trust here in town, ran the investment operation, eventually became vice chairman of the bank. And so didn't go back into the brokerage business, but ran substantial institutional trust pools of capital. And by 1998, we were introduced by mutual acquaintance, who a gentleman had heard me give a speech and told Bob, you need to meet Chris, and Chris, you need to meet Bob. And so we got together, he and his nephew, and talked for a couple months. And he told me at a point he'd love to have me take over the family portfolio. And I said, well, I'd be delighted to. They weren't a client of the bank, I worked for. I was running money for a bank trust company at the time and ran a mutual fund and was working with trust accounts and some public pension systems, ultimately running the St. Louis operation for what was a Kansas City-based bank. And so, we met in his office in Kansas City, or in St. Louis rather. And so, he said, but you can do it on one condition. You can't be working for a bank, because even though I ran a bank and I was vice chairman of a bank, I hate banks. He says, they don't manage money the way I think it ought to be managed. And my concentrated positions, it bothers me to no end to be signing letters of indemnification for my concentrated positions. I've managed the portfolio. I'm comfortable with these positions. And so, after a month and a half of talking, we launched Semper, and he asked me to come set up shop in his family office in St. Louis. And so over the course of his last years, he made it to almost 100 years old. this was late 98 when we got together, and as Jim put it in his interview, we joined forces, which I love the term. He'd come to the office every day, and they didn't tell about his last years, and I'd go see him at the house, but we'd carve out an hour and a half every day. He wanted to spend time with me, and I really enjoyed spending time with him. And his friends like Ned Putzel, who ran the OSS, was on foundation board that we had. And in terms of the portfolio, I believe there was a bubble. He believed there was a bubble, which was the impetus for our getting together. And so worked up a plan to start throwing assets into his foundation, and set up some CRUD accounts, which charitable remainder trust accounts that would feed he and Nancy, his wife, income during their lifetimes, which would eventually wind up in the foundation, which then would give and make grants via his family overseeing the grant making process throughout St. Louis in particular. But the beauty of doing what we did in the late 90s is you had a bubble in blue chip stocks in 98, Coke within the Berkshire portfolio. Mr. Smith had some Coke, was trading at 50 plus times earnings. The GE position was over half the capital. And at that point, more than 2/3 of the business was finance. Jack Welch had run it for a bunch of years. There's a great book out by Bill Cohen on the history of GE, which is I think a must read for anybody. But I thought GE was really a house of cards at that point. The leverage was off the charts. The off-balance sheet debt was crazy. And they ran the business on you got to make the quarterly number approach. And Jack spent a lot of time with the sell side on Wall Street and said, you can't have these reinsurance businesses and these insurance operations inside of a holding company and run them on a short-term basis. You're going to wind up with problems. And so he said, I'm back to benign neglect. He says, I get it. He said, GE was so valuable for the family that why don't we sell 90% of it? And so, I was able to sell 90%. And that was before the 1-for-8 stock split between 50 and $60 a share. The stock's still down 75% or thereabouts, 80% from where we sold it. And the interesting pivot at that point was in concurrence that there was a bubble, and his belief that it looked an awful lot like 1929, had discussions about whether it made sense to just sit in cash. And the market, as you know, William, was so bifurcated that you wound up with a tech bubble by early 2000. Well, anything value related under the surface was being given away. If you were a small cap value fund manager, you were getting redemptions in the last couple of years daily because people wanted to chase the NASDAQ bubble. The NASDAQ was up something like 84% in 1999. And the world just had lost confidence in real businesses. And so mid caps, small caps, real businesses just got crushed. And we were able to build a portfolio of real businesses trading for 6, 7, 8, 9, 10, 12 times earnings. And so pivoted into a very undervalued corner of the market, which wound up, wouldn't have expected it, but when the S&P 500 did fall almost 50% and the NASDAQ fell 80%, we wound up making 30, 35% during that 2000 to 2002 bear market. And so kind of fast forward to today.
The stocks that you bought him are up over 10 times since then. So you were saying that the delta is actually 50x because the stuff like GE would have been so killed. Is that right?
Well, against the GE position. Yeah, you think GE's was done 80% and we were up over 10x. And so, the performance record doesn't give you that delta, but you take $1 million to $200,000, or you take $1 million to $10 million, or more than $10 million today. Yeah, the delta is of 50, and it was very fortunate. It was very fortunate that we got together, and it was a highlight of my life because, in addition to being a great investor, he was one of the most kind human beings that I'd ever met. We developed such a great friendship. He was brutally honest. I had episodes when I grew up in a household with a kid, with individual that I really couldn't tolerate. My mother remarried when I was 7. She left my father. And I grew up seeing a lot of lack of ethics and lack of morals, and zero kindness and zero treatment of human beings well. I mean, the way women were treated was abhorrent. And so Mr. Smith was anything but that. He was the exact opposite. And he was just a great human being. He was philanthropic. He was modest. For his whole life, he'd given a lot of his money away charitably, and then ultimately started doing it through the foundation. But it was always anonymous. And certainly the big beneficiaries in St. Louis of his benevolence knew who he was, and they'd come visit the house. And it was fun for me to get to know the directors of museums and the garden and the zoo and things like that. But he was very modest, and which is why I thought it was so important to tell his story. And so I wound up, when we published the letter, I sent it down to his daughter, and she had just lost her husband, and I didn't hear back from her for 2 or 3 weeks. And I thought, oh hell, this has gone badly. I don't think she liked what I wrote, because she would have gotten back to me sooner. And she called me 3-4 weeks after I'd sent it to her and said, yeah, Chris, this was the most wonderful thing I did. I got very emotional. I cried. It stirred up so many memories of Dad. And, anybody that knew him loved him. And to be a friend of his and to be a mentee of his, really, and to be able to spend the regret I have is we didn't do video recordings like we're doing now of all of our conversations. I mean, there was so much. We should have. There should be a movie. There should be a book, and I'm not sure there's nothing.
There's a beautiful archive. There's a beautiful thing in your letter where you talk about what a giant of a man he was, and you say, shunning the spotlight in the extreme, a model of living not within but under one's means, humble, brilliant, hilarious, and charitable, kind to a fault. And you talk about how he would give money to charity, but it would always be anonymous. And you talk about how he was playing tennis to the very end. Albeit doubles in the end, but
he said he couldn't quite cover the court the way he used to, and so he had to resort to the doubles game.
Yeah. And then you say also, please take from the story the importance of saving, thrift, and living well within one's means. And so it seems like there are a lot of lessons from him as an investor, but also personally in terms of his courage, his sense of service during the war, his modesty, humility. Lack of display and ostentatiousness and arrogance and stuff. Is that fair to say?
If I had to pick a man, if I had to pick a human being to model one's behavior and life after, he'd be it. And I know my little segment of my letter didn't do justice to the giant of man that he was, but I hope it was a nice tribute, and it really felt great, and it meant a lot to me to be able to tell the story, at least in brief, the way I was able to do it in the letter. And I'm really thankful to his daughter for blessing the project, because I was, always so impressed with how private he was, and how modest he was despite the wealth. I mean, he didn't flaunt it, and he was such a curious guy. I mean, even after retirement from chairing the bank, he had all these great projects going on, and he was a voracious reader. He would have been a lot like Charlie Munger in that regard. He was incredibly well read, but he had these venture projects going on all the time. He had a smart card technology business. And at the very end, he thought we were going to trend toward needing to have digitization of health records. And he had a medical card that had a smart chip embedded in it where you'd be able to store your medical records. So he was working with Washington University here in town about some things that have come to pass and done in other corners. But he was curious to the end. He was always trying to figure out what was going to happen next. And I think, for somebody that would have loved seeing how the next 100 years would have evolved, it would have been Bob Smith. He truly was a giant of a man.
Yeah, and it's interesting. I read a couple of obituaries of him the other day, and there isn't much out there. I mean, there's something, I think, in a Princeton alumni publication, in a local publication from the place where he lived. And he died at 99 in 2002. And here we are 121 years after he was born, 120 years after he was born, and we're still chatting about him. It's an amazing thing, right? It shows that when you meet someone who really is remarkable, it leaves this kind of enduring mark. So I'm glad to have a chance to talk about him. I wanted to get a sense of what you think he saw in you, because I mean, in some ways, you were a kind of unlikely person for him to pick up in that way and to entrust with his family's fortune after all of those years, because you must have been about 30, right? And you'd studied finance at the University of Colorado in Boulder, and you'd worked at this bank trust company, and you managed money for a few years there, and you managed a balanced mutual fund there. So you were clearly smart and driven, and talented. But I'm wondering if there was other stuff, like if the fact that your father was a Marine and he had served in the Navy, or if it was the fact that he played football at Princeton, you played football very seriously at the University of Colorado, whether there was something that he saw in you that just resonated really deeply with him.
I don't know. We immediately hit it off. On the day we met, I was in my office and received a call early afternoon from his nephew, who said, "Look, I'm sitting here. I'm with my uncle." He said, "My name's Bob Smith, and I'm with my uncle Bob Smith, and a friend of ours said we should get together, and could we get together?" And I reached for my calendar to set a date, and I said, "Sure, I'd love to." He said, "No, I actually mean like right now, today." And so I wound up driving out, and we sat around for the afternoon and wound up going to dinner that night. And so probably spent 9 or 10 hours talking. And he loved the stock market and he loved businesses, and I hadn't seen the portfolio, but he'd be bringing up all of the companies that he owned. And I suppose it might have been just my ability to talk about just about everything he owned in depth, with just the work that I'd done just for the few years that I'd been an investor. I was 29 years old. We started the firm. We started Semper just slightly before my 30th birthday. But as I say, we spent over a month and a half talking pretty regularly, and strategizing a bit, and just getting to know him as a human being. And I'm not sure we got into much of my life story at the time, but from a personality standpoint and from a temperament standpoint, I think we hit it off. I loved his story about what he had done in 1928. I loved how he'd go about finding other businesses. The notion of minimizing the tax burden all resonated with me, and what I had learned to that point. And at that point, I was in the Berkshire world when I finally, too late, discovered Berkshire Hathaway. But I didn't follow Berkshire until 1996 when they issued the B shares and found the stock too expensive. Was stunned at the front page of the offering document when they did the B shares. They wrote the chairman and the vice. No, he's neither the vice chairman nor the chairman find the shares sufficiently reasonably valued or undervalued to we wouldn't recommend it for purchase to our families. And thought, well, who in the world does this? And was getting my mind around Berkshire, and at that point had read probably all the chairman's letters back to 1977, and so that resonated with me. And I'd already developed my own thoughts on executive compensation and stock options and the way accounting was abused, and that was very much a Warren Buffett thing, and that was very much a Bob Smith thing. So I think it was our interest in businesses. I mean, I find myself today, my whole friend group are folks that just love to sit around and talk about stocks. And if we're not talking about stocks, we kind of get bored. And he and I love to talk about the markets and stocks. And it was later, as we were working together, that the friendship really evolved. And I got to really understand who he was as a man. And anybody that's off to war and is in battle and sees death and experiences friends dying, usually don't talk about it. And he had said he rarely in his lifetime had talked about the war, but for whatever reason, he was very, very candid and very open about that chapter in his past. And, I'd love war history, World War II history, Revolutionary War history. So I was fascinated with that. But it was his temperance. It was his even keel approach. He wasn't concerned that he was missing out on the tech bubble. He said, "I've seen this picture show before, and it's going to end badly." And there was just a lot of commonality to the way we thought and looked at the world, probably beyond the stock market and the economy. But was a good fit from a personality standpoint. It was a good fit. I think had we been in the same generation and known each other, I think we would have been best friends at a time.
So you started the Semper Augustus investment group. It was sort of late 1998, early 1999. You got launched. So really, this is about when I was starting very seriously as a financial journalist, and so I remember living through this stuff, and writing for magazines like Forbes and Fortune and Money, and there was always this kind of credulousness in some of these magazines where, they'd be writing about these companies that, someone had just made $5 million off their tiny investment. And it was very intoxicating and sort of head spinning. And at the same time, I was kind of a born contrarian outsider. And so I never owned any tech, and I looked at it like, this is just moronic. And I ended up investing with Marty Whitman at the time. And so for me, it all sort of seemed nuts, but it was very intoxicating. And I was struck by the name that you chose for your firm, because it was a sort of ironic nod to the fact that this was clearly a bubble. There was a parallel not only with 1929, but also with the 17th century. Can you talk about why you called the firm Semper Augustus? What the historic connotations of this beautiful name actually are?
Well, it really was a contrarian bias, and I don't know if that's innate, if it's born, if it's learned, if it develops based on your life history. But I found myself very contrarian, very skeptical from the get-go. The first stock I bought shortly went bankrupt, and that makes you fairly jaundiced right out of the gate. And so I've always been fairly skeptical of everything I've read. But I love financial history. Even in college, I was reading everything I could, trying to figure out the investing game, and eventually got to Kindleberger, Manias, Panics, and Crashes, and Extraordinary Popular Delusions and Madness of Crowd, and all the Austrian school. And during what was the first real mania for tulip bulbs in Holland in the 1630s, the Semper Augustus was the most inflated of the bulbs, and there are great stories about that episode, and there are debates as to whether it really was a bubble. But there was a bubble in real estate, and there was a bubble in the economy, and there was a bubble in trade, and from the extension of that was probably this group of collectors that like tulips, and the Dutch have always liked flowers. In any event, the Semper Augustus was the most highly valued of all the tulip bulbs at the peak in 1637. In today's dollars, I don't know what would have gone for $3 or $4 million. They say you could have bought a flat on the river in Amsterdam for the price of one bulb. And interestingly, the bulb itself was genetically flawed. It couldn't reproduce, which was what produced if you know the picture of the flower, the red and white brilliant streaking in the bulb. But I thought and part of the reason we got together, Mr. Smith and I, was this sense that there was a bubble, and the bubble was, again, first in blue chips. The bubble was not the tech bubble yet. The tech bubble developed, but those big blue chips, the GEs and the Cokes, rolled over in 1998, about the time we were starting the firm. So we couldn't have sold the portfolio. We couldn't have done that at any better time. And then in that last period is when all the small caps really got cheap, and the mid caps really got cheap, and some Japanese companies really got cheap, and Berkshire itself really got cheap. After they bought Gen Re, Berkshire got cut in half, and it was only after the stock dropped by half that from 3 times book, we paid 1.05 times book for it. But the tech bubble, by the end of 98, was raging, and believing it was a bubble, and what a fool to start a business in the middle of a bubble. So the use of the Semper, which I always kind of thought I'd start a firm at a point, and harbored that name. I thought, oh my God, somebody's going to beat me to it. And I wish they did. I was praying every day that nobody would beat me to the name Semper Augustus. And
I was thinking about it this morning, actually, Chris, because I was thinking, that I wasted much too much time at high school studying stupid stuff like Latin, and I wish I had studied ancient Greek as well, but I was too stupid to study ancient Greek at that age. And so I was thinking, Semper Augustus basically means, always exalted or forever exalted. And I was thinking that's kind of interesting that Semper Fidelis is, always faithful is the motto of the Marine Corps. And you come kind of from this Marine Corps family and you have friends who are in the Marine Corps. And so I was wondering if sort of subconsciously it was like, in some ways it was a play on the Marine Corps motto. This was, what do you think? Is this a fanciful?
No, it's fanciful. It had nothing to do with the Corps. Although by that time, my great friend Jeff Goodell, who just retired a couple of years ago, was lieutenant colonel. As a Marine, it was what an honor to be at his retirement ceremony. No, it was very much this contrarian investing. I love the history of the tulipomania, the South Seas bubble, and I really wanted to put the stamp of something that was reflective of a mania on the firm, saying we're you're an idiot to start the firm at the top of a market, but here we are, and that's the name, and it is a bubble, and that's why we're calling the firm something named after what was a great bubble.
I dug out Extraordinary Popular Delusions and the Madness of Crowds, which is the book where I think you first read about the tulipomania bubble back in the 1630s. And there's this beautiful passage in it. It's talking about how crazily overvalued the Semper Augustus was, and how it says, so anxious were the speculators to obtain them that one person offered the fee simple of 12 acres of building ground for this particular tulip, the Harlem tulip. And then another guy bought one for a new carriage, 2 gray horses, and a complete set of harness. But then there's this beautiful passage where it starts, then there's an amazing story that's worth telling just because it's so ridiculous, which I'm sure is untrue, but I think it's too good to fact check, where some guy basically comes, I think, to deliver something to this
laborer.
Yeah, it's a sailor. It says the sailor, simple soul, and he sees what he thinks is an onion, and he takes it with him, and he's sitting on a bunch of ropes and is eating the onion, and doesn't realize that actually he's eating this unbelievably precious Semper Augustus tulip, and so he ends up getting arrested for felony against this merchant. But then there's this really beautiful passage that I just wanted to refer to because it all bursts, and it's so reminiscent. This account from 1637 of what's happened in March 2000 when that bubble burst, or with the Nifty 50, or with more recently when tech stocks started to blow up, or certain cryptocurrencies blew up. And it talks about how suddenly the confidence starts to go out of this thing, and people start to default, and people are suddenly left with these valueless things that nobody will take. And it says the cry of distress resounded everywhere, and each man accused his neighbor. The few who had contrived to enrich themselves hid their wealth from the knowledge of their fellow citizens and invested it in the English or other funds. Many who, for a brief season, had emerged from the humbler walks of life were cast back into their original obscurity. Substantial merchants were reduced almost to beggary, and many a representative of a noble line saw the fortunes of his house ruined beyond redemption. And so there's something just so wonderfully resonant about it, right? Like this is just sort of a part of human nature, and it just kind of repeats itself again and again. And it's done it for certainly the last 4 centuries, and obviously much further back than that.
I thought we'd never see what transpired in late 99, early 2000 again. The Janices of the world capturing half of all of the flows into the mutual fund complex and owning the same 20 stocks that all traded at what wound up being Cathie Wood, circa 2021 type valuations. The excesses in accounting, the excesses in compensation. And, here we are. We did the same thing, and we've done the same thing in the last cycle. And this last period here in the last year and a half feels an awful lot like what happened in the late 90s and even throughout 2000. You had the big break in March of 2000, and But you had a recovery. There's always a recovery bounce. It was the 1929. The market fell from 381 to 41, but it recovered to 190 and change by 1937. Then, of course, it fell off again, but that was World War II. But you had a recovery in 2000. From March, you had a big sell-off, and I don't think the S&P 500 hit its eventual high until September of that year, despite a big sell-off in the interim period. And so, you had the big sell-off last year in the NASDAQ, over 30%, the NASDAQ 100. S&P was down 18 and change on a total return basis. And here you are. These indices are all closing in on their 2021 closing prices. You've had this recovery rally, and valuations in some of the real businesses were starting to get reasonable. I think a lot of the stuff that was so speculative is still somewhat washed out. Although you've got recoveries in businesses that really shouldn't exist that are up 100, 200, 300, 400% this year. And, they're not near back to where they were. So the generals, the big 5 or 7 companies have recovered. But that same thing happened when Microsoft first broke and Sun Microsystems first broke and Oracle first broke during 2000. They all had a big recovery back to September. And then it just ground down over the next 2 years, 2001 and 2002. So it was 3 years of pain, but nobody believed it. You didn't believe the first sell-off. And I think there's this ebullience today. There's this bullishness that's returned among the tech crowd in particular that believes that, we're backing off to the races. And as Bob Smith said of the 1920s, I've seen this show before, and history repeats, and we're repeating it again. And that's the Extraordinary Powerful Illusions, man. It's Charles Mackay, and it's a wonderful read. My first read of it, and I read it many times, turns out to be the abridged version. Turns out there's a giant version, which I've now bought 3 copies of, which I haven't read yet. But it's going to be like reading War and Peace or the Bible. It's a pretty weighty tome, but it's very well written. Abridged. Really, it's a fun read.
Yeah, it's really fun. You don't know entirely whether it's factually accurate, but as Tom Gaynor might say, it's directionally correct, and it's elegantly done. And one of the things that's very interesting, actually, is that I think I write about this briefly in my book, that that Sir John Templeton loved the book so much that he republished it through his Templeton Foundation back in the 1980s, and he wrote a foreword. And so I was saying in my book that his foreword basically offered a rational antidote to financial insanity. And so what Templeton said in his foreword is, he said, the best way for an investor to avoid popular delusions is to focus not on outlook, but on value. And so he talked about the importance of grounding yourself in very specific valuation measures and in a critical analysis of a company's fundamental value. And that very much meshes with what you've done through your career. I mean, you're almost a maniac in your annual letter to clients, where you tear apart the financial statements of Berkshire in unbelievable detail, and you're going into the footnotes and the like, and really explaining what the economic value of these businesses is. Can you talk about that? The importance of, in a way, this whole other system of investing, right? That on the one side, we have the casino, where it's full of these charlatans. Like you've talked about charlatan promotion, right? Whether it's the SPACs or crypto trading or meme stocks and the like, all these things where people are somewhat unscrupulously making hundreds of millions of dollars from heavily promoting their SPACs or luring you into massively overpriced funds and the like. And then on the other hand, and in a sense, your early life was a kind of introduction to the casino element of it, right? I mean, back when you were at college, the stock that you lost money on, where you lost, I think, something like $7,000, was something where you'd read about it and heard on the street in the Wall Street Journal, and kind of rolled the dice and then realized, oh God, I knew nothing about this. So in a way, I see your career as a kind of renunciation of the casino element of investing and a shift towards what Templeton is talking about, which is, no, ground yourself, anchor yourself in fundamental valuation, And that's what's going to keep you safe. And this strikes me as such an important thing to explore for our listeners, because this is how they're going to protect themselves from, charlatans and unscrupulous promoters and bubbles. Sorry, it's a long-winded question, but the stage is yours.
Well, I think in retrospect, probably the best thing that could have happened to me was I was reading everything. I mean, I'd fallen in love with investing when I had moved from the engineering school to the business school at Colorado. There were no investing courses. We didn't have a student-run fund. This was not the Columbia MBA program. This was academic finance via the Booth School efficient market hypothesis. Finance was taught in a corporate setting. So if you were running DCFs, it was on a project basis and not on how to value a business. But I was reading everything in the library, in the business school library. I found myself at the Tattered Covered Bookstore downtown Denver, buying and reading all of the investing books that I could find. I was doing a lot of technical analysis, candlestick charting. I'd gravitated toward Bill O'Neill's CAN-SLIM method, which was still a thing. It's an acronym. It's essentially a momentum-based strategy of when earnings are breaking out and the stock price is breaking out. That's when you put your money to work. And so that's all I knew when I thought I knew enough. But I'd read this Heard on the Street column on this Norwegian, very large crude carrier company, and I thought, well, why not? This makes total sense to me. And so I convinced this retail broker, walked into the office with all of my money, my $7,000, which was some leftover scholarship money and everything I'd saved from my summer jobs in college and in high school, and plunked it all down. And the broker even bought a little bit. And he said, prudently, you should probably diversify if this is all of your money. I said, this is such a sure thing. But I had no idea what I was doing. I mean, I had never read a balance sheet or an income statement. I hadn't been exposed to financial statement analysis in the least. And so, when you lose all your money, you realize, good Lord, I either need to get a way different hobby or I better figure out what the heck happened. And so I had to write a letter over to Norway to get the financial statements. And as I learned by reading them, and I'm not sure I had no expertise, but I realized this thing was so levered. The structure of the business, which was a liquidating structure, they had these 4 ships. They were old. They were going to run them around for a while and then scrap them and sell the scrap for a profit. And everybody was going to make a bunch of money. But there was so much leverage. They were such bad assets. I learned 2 things. I learned this was a bad business. It was a bad capital structure. And I also learned price. You have to pay a reasonable price. So had it been a reasonable business but overpaid, you could have lost a whole bunch of your money. And so I've just very quickly, as I learned, realized the only way to protect yourself is with the business quality and the price you pay for that business quality. And so I became really a price zealot. And when I found myself in a professional setting in the trust company, the old United Missouri Bank, it was a value shop and it was a bank. So, hundreds of stocks in a portfolio, and the chairman of the bank, who was not an investor, mandated 25% cash reserves. But there was fundamental analysis going on. There were, analysis of PEs and price to books and price to sales and price to cash flows and dividend yields. I'm not sure there was that much going on in terms of a genuine understanding of what makes a great business and the differentiation between a great business and a cyclical business, which can be a great business at the right price, but a terrible business at the wrong price. I came to that all over the years, but I got grounded very quickly in then the business itself, trying to figure out how it works, whether it's a good one, and then ultimately the price you pay for it. And I think the lesson that so many people learned in 99 and 2000 and that they learned a couple of years ago is, even if you've got a great business at the wrong price is fashionable to say. A great business at the wrong price is a terrible investment. And
I just wanted to jump in here and tell you about this new valuable resource that we created for you. The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. If you're not satisfied with where you're at financially, whether that be not having enough savings at the end of each month, watching your cash being eroded away by inflation, or maybe you're not sure where to get started with investing, down in the description below, we put together a free guide for you called the 4 Simple Steps to take control of your personal finances and life. You can get this free guide by clicking the link in the description below.
I was struck by 2 things that you said. I spent a ridiculous amount of time over the last few days reading through old writings of yours and listening to lots of interviews and transcripts of your interviews. And I was very struck by a couple of things that I think are really worth our listeners internalizing, because they're so important and so fundamental. And one is that you said price is the paramount driver of what we do. And the other is that something you alluded to a moment ago that I think it's worth pausing and dwelling on, which is that you have a dual margin of safety, and the dual margin of safety is A, the price you pay, and B, the business quality. And I don't really see a lot of people talking about both of those things in terms of margin of safety, that it's not just the price you pay, but also the quality of the business. Can you talk about that a little? Because it seems to me a very important insight. And I remember you saying to Jim Grant, we're very disciplined on business quality and management quality. So, and likewise, later you talked with Peter Kaufman at Glen Eyre, and he talked to you about his checklist of six agencies that you have to satisfy in order really to have a high quality business. So this whole issue of quality is really critical, it seems.
Well, it's paramount to everything. And a lot of it can only be learned over time through repetition, through making mistakes. But it's very easy to start with a balance sheet and simply discern leverage levels, and within footnotes try to find off balance sheet liabilities, places where a culture is not run for the benefit of the owner, the shareholder, but it's run for management. And so you spend your time in the proxy statements there, figuring out what really drives managers and how they're compensated. You're trying to find the classic value investor moat, the thing that makes a business durable. You wind up loving oligopolies, places that are impenetrable. But at the same time, at least in my world, in our world, you've got to have the flexibility to, I think, more broadly define business quality. Again, we own a fair number of cyclical businesses today, but we've identified places where you've got some changing economics, where you've gone from hyper competition to more of an oligopoly structure. In the case of a commodity chemical business, Olin, here in St. Louis, which we've made an awful lot of money on. Half the investing world hadn't heard of it, and it's been public company for a century. They've been a dividend aristocrat since the 1930s. But it's a business that is in the chlor-alkali world. They take salt and a slurry of salt, electrify it, and make chlorine and caustic soda. On either side of the molecule, they've got a vinyls and an epoxy business through it. And I saw this industry consolidate. When Dow merged with DuPont, you saw Olin pick up a bunch of assets for antitrust reasons, which at this point, then 5-6 years ago, made Olin the low-cost player in this chlor-alkali world, vertically integrated as well by picking up the vinyls business and the epoxy business. And what I realized was, you're going to go through a period of a decade where nobody's going to build any supply. And if we have population growth and industrial production growth, Olin being the low-cost producer in the world, China's not going to be in a position to export product onto the market. They don't have low-cost feedstock, natural gas, the way an Olin would with its plants on the Gulf Coast, with natural gas feedstock sitting right next to the plant. In any event, that scarcity that was developing became a margin of safety. And I was able to look through what was a fairly encumbered balance sheet with the debt they had to take on You got to the pandemic and the stock got really cheap. We were buying it in the mid to high teens. The stock got down to $10 a share on 165 million shares. Market cap got down to 1.6 billion. Our basis in it was about 2 billion. And on a normalized cash flow basis, the business went in a kind of a mid-cycle level, do 2.5 billion in cash flow. So we paid less than one times cash flow for it. But in the pandemic, the end markets for so many of their product in the epoxy world, the auto industry slowed and closed plants. Boeing and Airbus closed, and so the paints and coatings businesses slowed. The end use for vinyl siding, housing market, housing construction slowed a bit. And so, the most optimal thing to do with capital would have been to buy the stock back when it was that cheap, but they had too much debt on the balance sheet. Well, as the economy and the business recovered, they've paid down the debt from over $4 billion to $2.7 billion. But knowing that you had this coming supply-demand imbalance allowed you to look through what was probably a more levered balance sheet than we ever would have done to where it's now a pristine balance sheet on a mid-cycle basis. Debt's now 1 times cash flow. The stock is up 5x from where we bought it. And here's a business where, again, if you're not going to add capacity at all, and in fact, they've taken out a lot of their lowest margin capacity, which has made the business even better than it was when I first started analyzing it. They're buying the stock back. They've gone in the last year and a half, 2 years, from 165 million shares out to 127 million. And the stock at 7 billion cap, up from our cost of 2 billion, is still trading at kind of a mid-single digit to what I'd call free cash. And so here's a place where you want this management team buying the stock back at as low of a price as they can get it. And so 20 years ago, 10 years ago even, I wouldn't have defined margin of safety in that setting, but you really understand how this thing was going to evolve. And as long as we were confident you'd make it through the pandemic, we were comfortable making it a big size position. And so it's not just these lists of 50 companies that get put together with all the great businesses that we all know are great businesses, the Visas, the MasterCards, the Costcos. At least in my world, you've got to be able to look beyond the refiners, which I was able to buy for almost free in 2000 when the energy component of the S&P got down to 1.5% from what had been double digits just a few years prior. European majors were shedding assets. Institutions, endowments, sovereign wealth funds were shedding their energy investments, and the whole thing aligned to where we were developing real shortages of capacity in various corners of the world. We have too little refining capacity. We've cut the number of refiners in this country in half. Starting 5 years ago, we started shrinking actual refining capacity. And so a business that was so cyclical that never would have been attractive to us became very attractive because you started to say, okay, well, business quality can be defined through something like a developing scarcity that's going to give you a lot of protection in the coming, what would be cycle, when you start to remove a bit of the cycle out of the cycle. And so it's my definition of business quality has evolved over time. We're still looking for the best businesses, the ones that if you take our overall portfolio and put it together as though it's a company, we essentially run no net debt on the collective balance sheet. We've got about 10% net debt on the balance sheet versus more than 50% for the S&P 500. A lot of our companies have net cash. They don't have debt on the balance sheet. The intangibles of, how ethical and how moral and how honest your management teams are, how aggressive or not aggressive they are with their accounting, that becomes a huge component of margin of safety when you're defining business quality. And when you put it all together, really the last thing that you'd want to focus on is price. But then you only want to buy these assets and these great businesses or these cyclical assets or these one-off special situations at a price that allows you to be okay if you're wrong on your thesis and if the business doesn't exhibit the same quality, or if the scarcities you think that are coming in a cyclical world don't develop as you think they're developing. And so price becomes really important, and it gets lost on the investing herd at secular peaks. It's completely lost on the tech crowd today. This big recovery in the big five and the big 7 or 8 companies has seen the what I call the Fab Five shrink from what was almost 25% of the S&P 500 at the end of 21. They got crushed down 36 or 37% in 2022. They're almost back to their highs. I mean, Microsoft is back to an all-time high. Apple's back to an all-time high. And they're back to almost 25%. You throw in Nvidia and Tesla in addition to the big five, and they're 30% of the index, and they're back to trading collectively at more than 30 times earnings. And these are bigger businesses today than they were 10 years ago, 12 years ago. They're not going to slow, but price matters. I mean, you may have seen the letter that I wrote that I think was interesting to Jim Grant that I put out in January 2000. So we had just started the firm and we were in this bubble. And I was so uncomfortable with what had developed in this tech world. The market cap of the NASDAQ. And I looked at this number I used to track. I had a spiral binder and then I had multiple spiral binders. I'd go to the Barron's Business Week section, which used to be really thick. It used to be thicker than what is now the entirety of Barron's. And they've removed a lot of that data. But I was just by pencil, just tracking hundreds of data points per week. You took note of the fact that the market cap of the NASDAQ, which was published in the Barron's, I had to infer that actually. They were giving you the market cap of the New York Stock Exchange, but the market cap of the NASDAQ, when you look through to Microsoft's percentage, you could back into how big the NASDAQ was. This is how I did it. The market cap of the NASDAQ was going to pass the market cap of the New York Stock Exchange in March 2000, even though 80% of the profits were on the side of the New York Stock Exchange businesses. And so I penned this fun letter at the end of 1999. On January 1, 2000, we published it with a series of predictions. It was the millennium, and people were worried about clocks on computers and the meltdown of the world that was coming. But I put out 12 or 13 predictions for the next 15 years, thinking, well, you're going to get held to task for being wrong for 15 years if you make a 15-year prediction. But I said, the first prediction was Microsoft shareholders will lose money for the next 15 years from today's price. And it had nothing to do with Microsoft being a bad business. It was a wonderful business. It still is a wonderful business. It was simply the price on $20 billion in sales and a 38% profit margin. So $7.5 billion in net income. The market cap was $620 billion. It's 31 times sales and 80 times earnings. I said, on a business that's not going to grow as fast as it had from its IPO 15 or 14 years prior, you went through an extrapolation of, well, what if the market cap were to grow at the same rate? Well, you'd be in the quadrillions of dollars. And what if sales would keep growing at 45%? Then, the business would essentially at a point consume the entire economy. And so I was right. And 15 years later, you had a negative total return. Even to today, start to finish, you've made a single-digit return on Microsoft, which is now back to the perch of number 2 largest company. It's, back to 37 times earnings. Its profit margin has recovered back to where it was in 2000, but paying that price, lent at best a mediocre return. And for 15 years, it delivered a loss. And so
Chris, applying that kind of lens to the current crop of fab companies, the Microsofts, the Googles, the Apples, the Amazons, and the like, if you were to make a similar prediction over the next 10 years, 15 years of places to avoid being, places where if you're really anchored in valuation in the way that you've had to be your entire career, what do you avoid? What would you advise our listeners to say, yeah, this might be an amazing company, it might be a great business, and it could continue to rise, but the odds are against you. Be very careful here. What would be a list of companies that trip off the tip of your tongue that our listeners ought to be careful of?
Well, I'd be very careful of the businesses that some of your software companies and a lot of what's in the ARC portfolios where you don't have profits, and you may not have profits, where almost everything has to go right, yet you're paying ridiculous multiples to sales. I'd always be careful of paying big multiples to sales for profitless businesses. But Nvidia reminds me today so much of Microsoft. low 23 years ago. Here you are with a transformational AI on a business that has been a very good business with their graphics chips, but on what's trailing 25 billion in sales, that's clearly going to grow very quickly over the next few years. You had a market cap that hit $1.2 trillion. Now we've got a short position on this thing, but you go through the same math on trailing 25 billion in revenues. If you grow those revenues at 20% a year, let's say, you wind up in a decade at 400 billion in revenues. And then you take today's 20% profit margin and you could look at it growing to 30%, look at it growing to 40%. And in any of those scenarios, if you grow the top line at 20, which is very difficult to do for any business for a sustained period of time, and grow the margins to a very healthy level, far above what a semiconductor business is normally going to earn. But if you allow them a 30 or 40% margin, and then you apply a 30 or a 40 multiple to earnings, only then can you make a 10+% return. I mean, you'd have to grow the margin to 40%, double it from where it is today. Now, there are Wall Street analysts that in the next 5 years think the profit margin is going to get to 50% and that the business is going to grow by 40% a year. Maybe it does. But when you start talking about 10 and 15-year periods of time, and you start talking about paying $1.2 trillion for a business that's doing 25 billion in sales on a 20% profit margin, even if you get this immediate surge in top line growth and an immediate surge in profitability, you have to presume a lack of competition. I mean, AMD, there are other players in the chip world. There's so much that can go wrong, but only in the case where everything goes right. When you extrapolate everything out, can you get to a mid to high single-digit return? So I would say Nvidia, you pay Nvidia today's price. I'd say the same thing that I did about Microsoft. Today's investor in Nvidia will lose money over the next 15 years.
And what about things like Tesla or any of the other big names? Are there things that just seem kind of strikingly obvious if you're anchored in intrinsic value and the like, rather than in momentum and hype and the like? I'm not saying this about Tesla in particular. I'm just wondering if there are other big names that leap out at you like that.
No, I've got a very short. I only short in one account, and I'm not a good short seller. I should never do it. But we've actually made money on our Tesla short. We have a very small Tesla short. We've got a very small Nvidia short. It's just we just recently put on. Tesla at what's approaching $1 trillion market cap again. I mean, they're now at $100 billion revenue run rate. Everything has to go right, and bothers me to no end. And evidently, Elon was out this morning singing the praises of ARK's analysts. I mean, one of whom is a CFA. And when they being ARK put out their first research report on Tesla a couple of years ago, you had these wild assumptions about robotaxi and wild assumptions about the number of EVs that Tesla would sell and their market share. And even things like, they assumed within a 5-year period, Tesla was going to sell its own auto insurance and they'd be writing as much business as Geico and Progressive. Numbers 2 and 3 in the field and only slightly behind State Farm, having done this now for 90 years each. In their latest report, ARK presumes in 5 years' time, 4.5 years' time now, that in their base case, Tesla is going to grow to a $7 trillion market cap, which is about the same market cap that the Fab Big Five sported just a month and a half ago. In their bull case, you get to $9 trillion. Elon said today, you think he think this business becomes a $9 trillion business, and he supports the robotaxi concept. I don't get it. I mean, so you're an auto manufacturer and you're grounded by conventional manufacturer margins and capital needs when you're building cars. If they're really going to grow to ARK's base case in 5 years' time, 10 million vehicles, you're going to need a hell of a lot more capacity than you have today. That requires capital. The beautiful thing that Elon did was talk the stock price up so much that they had several funding rounds. They went into these at-the-market transactions when the cap got up to close to $1 trillion. And they got Goldman and others to sell $5 billion here, $5 billion there at what was then 200, 300 times earnings, 20 times sales. It was almost free capital, and it provided the money to build out Germany and to build out Texas. But the artificial intelligence or the full self-driving, Tesla says you're going to be in production this year. There's no way. I mean, you're so far from getting regulatory approval from this stuff being safe. And then you think about the economics. So if Tesla's the car manufacturer and we're going to sell cars at these wonderful margins that nobody in the auto industry has ever been able to do, you're essentially going to, but we're going to have software. And so our consumer is going to pay a way higher price than sticker, because every upgrade, our car is going to get better and better. So it's not a $30,000 car, but it's going to be a $50,000 car, but it'll be a better car 4 years from now than it is today because of the software. Not sure I buy that. And I really don't buy the concept of Tesla, the full self-driving Tesla, buying cars from Tesla, the manufacturing side, making wonderful margins. Now, this car side, which is the akin to running a yellow cab business or what's now an Uber, well, Uber killed the yellow cab medallions in New York City. The Uber business doesn't make any money. And the drivers, if you look through to your actual overhead of insurance and depreciation and fuel costs and the opportunity cost of your driving an Uber versus going out and having another job, the Uber driver doesn't make any money. So, but all of a sudden now we're going to go to full self-driving because it's going to be safer and everybody's going to adopt this and nobody's going to drive their own car. And we're going to have wonderful margins on the FSD side as well that supports what's now a $9 trillion market cap. That's the number that these folks at ARK and now Elon's talking about. The total market cap of the S&P 500 is $38 trillion today, but we're going to grow to 9. You mean you're going to be bigger than the 30% market cap today, Tesla included, that the big 7 stocks make up of the S&P, and we're going to get there in ARK's prediction 4.5 years. And Tesla says you ought not listen to anybody but ARK because their analysis is really good. Well, that's dangerous and that's puffery. And you start to measure the integrity of management and the promises that are made. I'd steer as far away from a megalomaniac at the helm of a business. And that's just not, it's not setting the expectation bar with any level of reality, but it now starts to border on hype. And when the retail investor is the one that gets harmed by the puffery, that gets my dander up a little bit. It's some of the behavior that we've seen in the SPAC world with some of these charlatans that have really just been in business of enriching themselves and abusing the retail investor. Look, if you're running a hedge fund and you want to drink the Kool-Aid and play the game, fine, so be it. But it's the retail buyer of stock that is the one that really bears the brunt of the pain. I mean, the institutions, plenty of them got wrapped up. And there were a lot of really great investors that drank the tech Kool-Aid in 99 that blew themselves up. And, they were down the full 80% with the NASDAQ, and price was not a thing with them. It was all about, business quality. Well, in this latest iteration, everybody's going to be the next Amazon because you should get a hall pass for making money for an indefinite period of time because this technology is going to be so wonderful. I mean, everybody ought to go read Robert Gordon's book on the economic history of the United. Forget the title of the book. I've recommended it in my letter. It's a really long book. He's a Princeton professor.
This is the one that took you 2 years to read?
Yeah, I mean, forever. But it's a wonderful history, and it essentially goes back to the great technologies post the Industrial Revolution, and they were so transformative. All this AI and SaaS software and even the internet is more incremental to real GDP growth per capita than some of those transformative changes were. And you've got to put it all in perspective. But
I wanted to ask you a related thing. This whole issue of these great compounders, these great businesses that truly are high quality businesses, right? And you've owned a bunch of them over the years, whether it was starting with something like Ross Stores around 2000, or then Costco around 2004, Starbucks, Nike. These really truly great long-term outstanding businesses. And there seems to be a kind of tension in your own investment career over how long to keep them and what to do when you're truly anchored in this notion of intrinsic value what to do when a great business starts to get really pricey. And you've told the story a lot of the early mistake that you made in Ross Stores, where you bought it in 2000 for about 10 times earnings and then sold it in 2002 after making 150% and then watched it go up 25-fold. And so this is something you've wrestled with a lot. And I'm just wondering how you deal with it, because it's kind of become almost an orthodoxy that there are certain businesses that are great enough that you shouldn't sell. And yet over the years, I've seen you cut back things like Costco and Nike, almost like you can't bear to hold them because they just get too expensive. How do you wrestle with this kind of eternal dilemma?
No, I can't bear to hold them, at least in size. Yeah, that's well put, when they get that expensive. But what I've learned is, don't eliminate a company you want to own forever from your portfolio in its entirety, because it becomes that much more difficult to bring it back into the portfolio. We only bring in 1, 2, 3 new names a year. And to bring something new in, I've generally got to have something that's going out on the other end. It's not a perfect, I'm going to sell something entirely and bring something in. It's just, you find so many new things that you want to bring in because because you like what you own. But price does matter. Now, having trimmed the Costco position back, and we still own a bunch of it in taxable accounts, I'm not going to sell my $19 cost basis Costco, where we've made $19 in special dividends, another $20 in regular dividends on the stock at $5.50. If you have a taxable investor, where you're probably going to get unless we change the tax code, a basis step up at death, I can't afford to pay the tax. I mean, I'm a buyer of the stock on a 25 or a 30% decline from current prices. But I mean, Costco's traded as high as 50 times earnings. It's trading at over 40 times today. I can't buy Costco, but I can sure eliminate it out of a non-taxable account. Nike, which had gotten to be we've made a lot of money in Nike. It's a 0.5% position, and I'm chomping at the bit to bring it back in. Lou Simpson, turns out, who ran Geico's portfolio, of course, had adopted this theory at a point in life. I've recently learned that he never wanted to get rid of his great businesses. So I've got a handful of companies in the portfolio that and it's also part of our process, William. My turnover has averaged 20, let's call it 15% a year over the last quarter century. If I'm bringing in I brought in one new company all of last year. Maybe a third of our turnover is the elimination of a company from a portfolio. And the cyclicals are going to all have to go at some point. Olin's going to have to go at some point. I can't own a business that's not going to grow at all for 30 years, but I can trade the heck out of it in the interim, and eventually it's got to go. Most of my activity is trimming the most expensive portions of the portfolio and buying the things that are the cheapest. You can see what I've done with a Dollar General over all the years. We bought it back in 16 or 17 at, I don't know, high 60s, maybe $70 a share. It was trading in the mid-teens. The world thought Amazon was going to come along and the internet was going to come along and kill all retailers. Well, Dollar General has a whale of a moat around it, given their rural footprint, given the economics of the median household that is their customer. I don't think that at that price point and what they sell, you can be displaced by the internet. And so we found a moat in a business that went begging. They'd been taken private in 2007 and came back out with a bunch of debt in 2009, and that debt had to get worked down. But it was a wonderful business, and all through it was a wonderful business. And so we bought a bunch of it and made a bunch of money. They were a clear beneficiary when the pandemic hit. I think at its low in March, the stock was down 12 or 13%, and then it wound up being up a whole bunch for the year. So, where I tend to now stay, once I'm fully invested on a portfolio, I tend to not raise cash. I like to be fully invested. When I'm buying Valero and I'm buying what was Holly Frontier, now HF Sinclair, and I've got to raise money, I'll go to a Dollar General that was then trading at about a full valuation and take it from a 4% position to a 1% position to free up 3% of the capital I needed to buy the refiners. And so here you are, fast forward. Well, you've got some operational issues today with Dollar General. The tax rebates are not what they are. Now, they're a customer at that business. is essentially half of U.S. household median income. The business tends to do absolute worst right before a recession. In a recession, the use of SNAP, which is the food stamp program, escalates. And so Dollar General winds up being a better business when the economy is at its worst. Well, the economy was at its worst in the pandemic. And so, Dollar General wound up doing way more revenues per store and way more profit per store than they had done. And so some of that's now on the backside of that working off. The states are one by one pulling back out of the surplus SNAP benefits that the federal government threw the states' ways. And so that's all going away. And so you've got some things going on, but the stock is now kind of back to where it was when I was selling it a couple of years ago. The business is bigger. They've added 1,000 stores per year. So you're pushing 20,000 stores today. But I've just made Dollar General a very big position here in the last month and a half, because it's now among the cheapest companies in the portfolio versus what was one of the most fully valued companies in the portfolio 2 years ago. Under the hood, you don't necessarily see that if you simply look at a list of Semper Augustus holdings, but it's the value that's added by trimming the deer and buying the cheap at the margin that I think delivers an enormous amount of value over time. And that's very much predicated on price. I mean, this has nothing to do with, and I believe the issues that Dollar General is grappling with now operationally and on the regulatory front and on a little bit of changing distribution as they've changed the footprint of the stores and they're making their base store model 1,000 square foot bigger, 1,100 square foot bigger than the typical 7,400. I think this management team is so good. Their board is so good. Mike Culbert, the chairman, I've gotten to know, he's phenomenal. These are very good retailers. They'll fix the current issues. And again, some of these issues are simply the flip side of the business being pulled forward, being too good for a year and a half period of time. Now you're kind of back to where you were in 2019 on a margin basis. It'll fix itself, but opportunity cost, I would throw, if we're talking about business quality price, that all meshes to where when you're a portfolio manager and moving money around and you're trying to put money to work, it all boils down to opportunity cost. And it's not so much any hard and fast multiple to earnings or to cash flow or to book or whatever, but it's Dollar General's one of the best names right now, front and center in front of me. And they're corners of the portfolio that have gotten a little more fully valued. So when I'm buying DG, I'm trimming other things in the portfolio. And I think that's how you wind up keeping the overall portfolio at a reasonable valuation at most of time. And it's the mesh of those price, opportunity cost, business quality.
So again, totally anchored in intrinsic value, price, looking always at opportunity cost, and opportunistically trimming and adding. But then it's not really an exception because you've trimmed and added here to Berkshire as well. But Berkshire obviously has been an enormous part of your portfolio going back to 2000, when, as you said before, it had halved. And I think you bought it in February 2000, initially at about 43,700. And here
43,707. There was $7 a commission, so it was 43,707.
Yeah, and so. I mean, and this has grown at times to 20 or 30% of your client's portfolio. So it's clearly a very important anchor position, and you're best known really publicly for your enormously detailed analyses of Berkshire, which you do each year in your shareholder letter. So I wanted to talk a little bit about Berkshire because it's so associated with you. And you're pretty much unrivaled in your understanding of the minutiae of the business. When you were writing about Berkshire in one of your annual reports, you said it's run by the world's most skilled and shareholder-friendly management team, and that it embodies how capital should work, and it is probably the best business to study if you want to learn how to invest and how to run a company morally and ethically. And I wonder if you could just talk a little bit about Berkshire as a kind of model for others, what other CEOs and investors can learn from Berkshire about things like rational asset allocation and running a company in an ethical way and looking out for shareholders, these very fundamental things that I think so much of the casino side of the investing world forgets about?
Well, I think Berkshire should be studied by managements. Rarely are companies led by great capital allocators. CEO comes out of operations in many cases. CEO comes out of finance in many cases. Managements are largely compensated with a nominal base salary, but then in most cases, some varying degree of bonus, but then largely stock options, restricted share units, and the hurdles that are put in place to be rewarded with your options. It's not just time vesting, but they're performance elements. And a lot of times they're things like revenue growth, and they're things like EBITDA, and they have nothing to do with any kind of return on asset, return on equity, return on capital. Well, from day one, Warren Buffett ran Berkshire to grow its book value per share, and to not put the business in harm's way. And when it was in harm's way, to pivot. When the first business they owned, obviously, was the textile business, and famously ran it off and eventually closed it in 1985. Several of the first businesses they bought, blue chip stamps, diversified retailing, wound up essentially being zeros, and they pivoted away from those. And it's been this capital allocation at Berkshire that's allowed it to be so successful. But it's beyond that. It's the treatment of the shareholder. And with Warren as the largest shareholder, he's run it for, and this I'm going to say this wrongly, but he's run it for his benefit, not so much to line his pockets at the expense of the other shareholders, but at the benefit of all of the shareholders. And so it's the lack of abuse in accounting. It's making rational acquisitions when you're laying out capital. You don't have a litany and a long history of write-offs and write-downs. The $10 billion write-down of Precision Cast Parts, he's acknowledged was a mistake on price in particular. I mean, the business got worse. Part of it was already in bad shape. The turbine business was already in bad shape when they bought it. Who would have known with the pandemic that aircraft manufacturing would go through the lull that it did? But he paid, and I thought we owned the stock. I thought he overpaid for it. And I think he probably has backed away from the big elephant hunting with the lesson of having overpaid for a business that did get harmed in various ways. But you've got so much alignment, and it's so easy to learn the lessons by simply going back and reading the chairman's letters.
Yeah, I thought it was striking that you, in one of the letters, you pointed out, for example, that Mark Zuckerberg, for example, had paid, I think, $330 in 2021 for shares that would later be worth less than 100. And you were just talking about the fact that, not
of course now 331 again.
Yeah, but not to gang up on Mark Zuckerberg, who's obviously brilliant in his way, but the lack of discipline in a lot of companies about things like share buybacks, where instead of buying their stock back when it's cheap, they'll buy it back kind of any time. The sort of short-termism, and it seems like I mean there was something very, very striking to me in a lot of your writing about return on capital, and maybe Berkshire is kind of the best way to look at this. You said in one of your letters, we think at least 90% of publicly traded companies aren't worthy of investment because they don't earn their cost of capital. Companies that slowly lose capital have generally been able to raise new capital and mask what is really going on. In that way, many businesses operate on the order of a legitimate Ponzi scheme. So can you talk about how a company like Berkshire, that's very rational about cost of capital, return on capital, how it embodies this kind of just much more logical and intelligent way of thinking about its investments?
Well, the levers of capital allocation are known and understood, at least by the value investing world. There are only so many things you can do with money. And from a capital allocation standpoint, I had a chart in this year's letter which looked at the last 5 years of capital allocation at Berkshire, and it started with cash flow from operations from the cash flow statement, netted out depreciation expense, which is a real charge. And in Berkshire's case, I think in a lot of companies' cases, depreciation expense essentially matches what you'd call maintenance CapEx as opposed to growth CapEx. Berkshire has a lot of money being spent in the energy world where they're growing the footprint of their energy assets. But there you can do things with the share. You can issue shares in transactions. You can issue shares to management as compensation. You can buy back the stock, and the price at which you buy it back becomes critically important and so little understood by most CEOs. You can use leverage in the capital structure. You can issue debt. You can retire debt. You can spend money on CapEx, on growth CapEx. You can spend money on growth R&D. You can make acquisitions using any of the combinations of capital available to you, internally generated capital, net new capital, either through the equity markets or the debt markets. And then I had to throw off one-way line in my table this year, or you can buy a jet or jets, or you can have birthday parties, and you can have a birthday party with matriculating ice cherubs of vodka. That's a nod back to the Tycho, Dennis Kozlowski days for, Dave, youngins that don't remember the Tycho saga. But that's all you can do. But I don't think that's what CEOs sit around thinking about. I think they look, if I'm paid, if I'm incentivized to grow EBITDA, they're going to go grow EBITDA. If that's what drives their comp package, well, that's above the line. The components below the EBITDA line, interest is a very real thing, interest expense. But you become indifferent as to the capital structure of the business. If you're paid to grow the top line and you're paid to grow EBITDA, you become a lot more tolerant of leverage in the capital structure because you're measured before the interest expense. And in so many cases, you'll put the business in harm's way with excessive leverage, but you're not paid to keep the business out of harm's way. You're not in the captain's chair as CEO, as Warren has been since 1965. You're in the captain's chair for 4.5 years on average. And when you're given big option packages and big RSU packages and big PRSU packages, this is your chance to make money. And your motivation becomes, in so many cases, short-term earnings, making Wall Street happy, driving the stock price up. And the share repurchase becomes front and center, perhaps your best use of capital. Now, I'd also argue that so many companies don't have the opportunity set to go invest in growth CapEx intelligently. They don't have the opportunity to go invest in growth R&D. So what do you do with the money? Well, if you look at it's fascinating to me. You've got this $38 trillion market cap for the S&P 500. The share count for the S&P 500 is exactly the same where it was 23, 24 years ago. If you look at the percentage of net income or the percentage of cash flow from operations that have been spent retiring shares and buying stock back, last year it was $1 trillion out of the $1.6 trillion in aggregate profits for the S&P 500. Between dividends and share repurchases, there's nothing left for the S&P 500 for the last 20 years. And you've been buying shares back at 20 times earnings at a 5% earnings yield. Well, if you can go invest in a project, if you really have a business that earns 15 on equity, do you really earn 15 on equity if you can't go reinvest at a 15 ROE, but your best use of capital is buying the stock back at a 5% return? This is not normal. This is not normal boardroom conversational strategy, thinking this is not what the CEO's laying away thinking about at night. But if you're Tom Linebarger at Cummins, who's retiring, God love him. He's one of the best CEOs and this best management team. The new CEO, I forget her name, she's come up through operations, but the whole management team, they've all been there forever. I mean, they've been at Cummins for 20, 25 years, and they have a culture of their compensation is driven by the performance of their business units. And when they get to the executive level and they start to be compensated with options and RSUs, it's all very return on capital based driven. It's very return on asset based driven. And you love to see that because in that setting, the decision making of how capital goes in and out the door becomes very aligned with the shareholder, and they're just very, very good. And so getting that alignment right is so critically important. And if you take the time to read through everything that Mr. Buffett, that Warren has written about executive compensation and stock options and accounting and the treatment of the shareholder, it's just, I don't think the incentives aren't there for the managers to go live that way and think that way. They've come up through the system of seeing how their mentors got rich, and they're going to emulate that behavior. They're not going to emulate this old guy in Omaha who's really aligned himself with the shareholders. And I think he thinks deeply about treating all constituents well. It goes back to your note about Peter Kaufman and our conversation when we ultimately led to how Costco runs their business. But it's taking care of your employees. It's taking care of your customers. It's taking care of your community. It's taking care of your regulators. And through all that, the last thing it's taken care of is the shareholder. And there are great businesses that really are aligned in differing degrees, but that's really what you're looking for. Now, you have places where you think you have that alignment. You just have bad businesses. Most insurance operations are not good. I mean, especially underwriters or brokers are a totally different story, but insurance underwriting is brutal. And it's very, very difficult to approach underwriting from a conservative standpoint. Lending, banking is very brutal. If you go back and look at the long-term stock price charts of almost all of our leading banks over the last 25 years, and the stocks are below, or they're not much above where they were 25 years ago. They're cyclical. You lower lending standards at the peak of a cycle, and you wind up with write-offs and losses. Then you wind up having to recapitalize your shares at the most inopportune time. Some of the reason that the divisor on the S&P 500, the share counts where it was 25 years ago, is because every time you have a recession, you write off so much of corporate assets and equity, and you've got to recapitalize. And you're winding up now capitalizing when the share price is the cheapest. When it's the most attractive from an investment standpoint, you're not buying it in, but you're issuing it because you need the money. And so, the share repurchases tend to be a disaster at the wrong time. It's when you should be buying the stock back. Olin couldn't buy the stock back in the pandemic because they had $4+ billion in net debt on the balance sheet. Today, they've got $2.7 billion in net debt. It's a better business, and they can buy it back. The stock's trading at 5 times earnings. It'll be a private business in 20 years. That's a great use of capital. This management team at Olin absolutely gets it. But those managements, to your point, and to your comment, they're fewer and far between. But that ought to be the quest of any investor is finding where you've got the alignment of incentive.
I'm also struck by just how difficult this stuff is for an investor. I mean, when I look at the kind of analysis that you do, you're having to really drill down and get a sense from the company's financial statements of the true profitability of a business after all the write-downs and the litigation expenses and funding defined benefit pension plans and stuff. And some of it just makes me think, really to get a sense of the true earnings power of a company and really to get a sense of its true intrinsic value, even approximately, is just such a difficult game. And that it just seems to me that for most investors, they should just not be playing this game. It's too difficult to buy individual stocks. What do you think?
Well, I think it takes the proper wiring. One, I think it takes a little bit of the contrarianism, the skepticism. I'm very jaundiced. I mean, when I'm talking to management and I'm reading Ks and filings, I'm always looking for where I'm being lied to. And maybe that goes back to my upbringing and being in a household where where you didn't have the honesty and you didn't have the behavior that you'd really want to see. But I also think it's repetition. I think it requires an awful lot of time and purpose. You really do have to have a thorough knowledge of accounting, but you have to know not just accounting. I mean, you can't just simply take some GAAP earnings number or even think you're making some accounting adjustments and throw some multiple on it, or you do it via running a DCF. You can tweak your models to get the output to be anything you want. It's really understanding over time how accounting is either judiciously applied or not. It's what is the history of write-offs and write-downs? I mean, if you do have a return on equity component to your compensation and you're in the business of making a lot of acquisitions, maybe you do want to every cycle take a bunch of write-offs, write-downs, deflate the equity number, which in turn in the next cycle, when your profitability comes through, it's now against a lower equity base because you just taken a bunch of accounting write-downs and write-offs. Since the mid 1980s, on average, the S&P 500 has seen 15% of operating earnings written off and written down to charges. And that tends to be the most extreme and at the highest during recessions, during times when times are bad. You don't have as many write-offs when times are good. But what is book value? And book value can get distorted by repurchases of shares at a big premium to book value, which may or may not make economic sense. What is net income? I mean, is it understated? Is it overstated? If you're doing a lot of deals and you're writing off intangibles, what kind of intangibles are being written down? If you have a lot of patents and you're in the drug world, patents really do lose value over time. If you're buying businesses where economic earnings are durable, the intangibles that are customer lists should not lose value over time unless you've overpaid. Then, of course, you're going to make charges to intangibles and goodwill because he overpaid for a business. It's not as good of a business. So it's hard. It takes a lot of work. I'm fortunate to be, and I love this. I love being on college campuses a lot. And, just kind of passing along some of the few things that I've learned. And I always say, look, you always get asked for, what one book should I read that'll teach me how to be a great investor? What podcasts do you think are the best? And my point is, get away from largely, thinking you're going to learn something vicariously through an author or through somebody talking. I mean, I love these podcasts. You had Ray Dalio on. Obviously he's brilliant. He's a genius. But, given an hour or given 2 hours, I want to figure out what's going on at Cummins. And I want to figure out what's going on in the world of hydrogen, because these are the things I worry and think about.
Well, part of the lesson for me, Chris, has been the more time I spend with really superb investors, the more I realize how ill-qualified I am to play the game on my own. And so it's really helpful for me to study great investors, because then I start to think, all right, well, I'm not wired that way. And I'm just not as interested. And it struck me, I was thinking about this the other day. I was reading one of your annual reports, and there was a moment where you got really excited in the annual report, and you were saying, the light went on when I was looking at like this footnote about the tax treatment of the Burlington Northern Railroad that Berkshire owns. And then I realized, oh no, there's the equivalent of float in there, that's not really understood. And I was just thinking, God, I just don't give a damn in comparison. And so for me, look, I own Berkshire, right? And I love Berkshire. I'm totally biased, but literally part of what I do each year, I'm embarrassed to say this, but I read your report and I'm like, okay, well, here's how he's valuing it 4 different ways. And I trust Chris to be really assiduous with this. And I'm like, I'm done. And I'm happy, and I trust the values of Berkshire and Buffett and Munger. And I trust that they're not out to screw me. But I'm kind of almost like just outsourcing the really serious analytical work to you, because I'm not interested enough or capable enough.
Well, I have no doubt in my mind you're capable enough. But you said it. I think it's level of interest. Warren talks about tap dancing to work. I have never felt like I've worked in the business of money management. I'm just so intellectually curious about business and industries, the companies I own, the competition, finding new ideas. That's all that interests me. You try to read books on behavioral economics, and I get through a few pages and I can't do it. Podcasts, Ray Dalio's a genius, but okay, you meditate. I guess my meditation is worrying about what's going on in the displacement of the Class 8 diesel engine.
But you're walking like 10 miles a day, right? So that's presumably one of the habits that in some ways is your equivalent of meditation, where it's enabling you to disconnect from the office, to disconnect from the noise, to quieten down a bit, to get some peace, to get some perspective, right? I mean, that's really, so, I mean, I think you've just found a different kind of habit to keep your sanity, no?
It is. And even here in the last 3 months, I'm getting ready to have my hip replaced. And so it's been very hard for me to walk. I've got with all the surgeries on the knee and the damage I did to the body playing football and time in the weight room and all the sports I played, the body's broken down. My left knee, I've been deferring a replacement for 7 years. The hip got really bad 2 years ago. Surgeon said, dude, this is one of the worst hips I've ever seen. So I did a cortisone shot before going over to Switzerland and Italy, just to allow me to walk around. And I started taking a COX-2 inhibitor. And I really had to make myself walk more than my typical, 1 mile a day. And so I'm up to trying to walk 20,000 steps. And so, here I am in all of July. I'm now walking. I have an 8-mile course. I change up the course a little bit, but that it takes time. So I'm out there walking for 2.5 on average hours per day. And you can either listen to music, which I like to do, and that gives me time to think. I mean, it's the time where I'm not engaged in analysis and I'm not on the phone and I'm not emailing. It's my time to think. I'm not really listening to the lyrics of the song. I'm thinking. But I'm walking so much more now, and I've lost 30 pounds, which is great. Knowing I'm coming on your podcast and listening to your podcast, and they're phenomenal. I mean, they're genuinely wonderful.
Thanks.
So I can take 2 hours listening to your podcast, and then I can go through what my form of meditation is, and that's thinking about what's going on in my life and the world and the portfolio and the competition that's coming and all the things that matter to me. And I guess everybody needs a channel to get out and get away and bring themselves to a calm.
It's also striking to me, Chris, that you have you were saying to me last week, look, if you need more time to dig through some of my annual letters and interviews and the like, it'd be easy to postpone our conversation. And you said, I have no travel and a very open calendar. And I was really struck by that, this idea of having a very open calendar. And likewise, I've seen you say that you have a kind of ADD approach to structuring your day, and that while your business partner who you've worked with forever is very structured and very orderly and very systematic, you kind of leave your day largely unstructured so that you can do your research and the like. Can you talk about that idea of how you structure your life so that you can think and work independently and peacefully and get some perspective on the investment world rather than being kind of sucked into the mayhem, the noise and confusion that most investors are subjected to?
Well, I'm blessed, to your point, with a great business partner of 25 years, Chad Christensen. In the early days of the firm, we had to wear a lot of hats, a lot of blocking and tackling. And so you find yourself spending a lot of the day involved in running the business, setting up the business. Mercifully, he, through the team he's built on our operations side, I've taken all the hats in the firm other than the investing hat away from me, which is a wonderful thing. And I'm blessed with a wife that I don't deserve. And I'm blessed with 2 kids that I don't deserve. I think if you observed my household life, you'd find it pathetic because I don't do anything. I am loath to admit this, but I don't cook. I occasionally do some dishes. I don't do the laundry, outsource the lawn mowing. I kind of grew up with a lawnmower in my hand and doing all the jobs and all the projects, and I did the laundry and I swept the floors and vacuumed the carpet. My life it's luxurious, but I have all the time to do what I'm interested in doing. And that's doing what I do for a living, which doesn't feel like I'm doing it for a living. It's just something I enjoy. And all of my friends, my colleagues, again, another lesson that I tell students is, look, if you've got bad people in your life, and I've been using this message for years, get the cancers out of your life. I said, you're going to look around the room, the classroom. Very few of these people are going to wind up being permanent friends, unless you're in a place like Columbia's MBA program where you're going to have a great social network. But I mean, how many high school friends do you still spend time with? How many of your college friends you don't? And I said, when you have families, to the extent you have families, your friend group is going to change based on your kids' activities and where they go to school. If they're playing sports teams, you're going to spend time with the families of the sports teams, and you're going to spend time with the families at schools and whatever their interests and activities are. So, but from a professional standpoint, your friends and your profession, if you like your profession, so first I say, if you don't like what you're doing, you're looking at the clock at 4:55 because you can't wait to go home. If you can find something else to do with your life, do it. Because if you find something you get paid to do that you like doing, that's a great combination. But I said, build your friend group carefully. And I've been really, really blessed and lucky over the years to develop some wonderful friendships with like-minded, not cookie cutter. We don't look at stocks the same way. But I have a group of 25 or 30 really good friends, a handful in particular that I spend a lot of time talking to. One who I talk to 3-4 times a week, typically. The two like that. Spend a lot of time with one in person here in town and another on the phone with. But if you have bad people that enter your world, if you have immoral people, and maybe this is a lesson that I learned when I was a kid, which is interesting because I lived and I set out to live an exact opposite life of what I had seen. A little bit of a boomerang effect there. I had one brother in the house who, in the same setting, observing the same sets of behavior, co-opted the behavior that I found so repugnant and has chosen to live his life that way, which is very interesting at minimum. But the message to students is, look, if you wind up with immoral, unethical people, if you wind up out with people that don't make you feel comfortable because they're abusive to servers, get them out of your life. Surround yourself with kind people, good people.
So, Chris, I keep hesitating to ask you about this, but you've referred to it a few times, and there is the journalist in me that can't resist. So forgive me. But you've mentioned a few times the growing up situation. I'm wondering, is this your father? Is it your stepfather? I mean, what was going on? Because it's obviously had such a profound impact on you in terms of you defining yourself by not being that way and by gravitating towards people like Bob Smith or towards Munger and Buffett, or also to your football coaches when you were growing up, who've obviously had a really profound impact on you as moral exemplars. And so I just wanted to get a sense, if you don't mind me asking, of like what is it you're referring to? Because you obviously had a very intense and kind of traumatic formative experience there.
Well, I don't want to get, and I won't get into too much detail, but I lost my mother this year. She passed. She'd be the poster child of why you shouldn't smoke. She smoked from the age of 12 on, a couple packs a day, and wound up ultimately passing of COPD. But she wound up in a relationship with somebody I really just didn't like for a whole host of reasons from the get-go. I found the behavior unsettling. I just observed a way to live a life that was not great. And throughout her life, there was just a lot of dishonesty, the way women are treated. Very much with intent, chose to live my life 180 degrees opposite. And I set out to be a different father. And so I've gone out of my way to raise my kids differently than the experience that I had when I was a kid. It was important to me to be involved in their lives and their activities, to be good to them, be fair with them. What a privilege to coach some of their youth teams. And you mentioned my football coaches. I go through the roster of each of them, and they all had a profound impact on my life, and they were all genuinely good men. And I got to be very good friends with my high school football coach, Brian McGregor, in life. And these were all men of integrity, and they were men of honesty, and most of them were hard. I mean, football coaches are hard. They're hard on players, but at bottom, they were fair. And so many lessons of life on how to behave and how to behave with modesty. So no, I just lost my mom 4 weeks ago. She was in hospice for 4 or 5 weeks, and there were just a lot of horrible things at the end that maybe I'll tell you over a beer sometime. But
yeah, I'm so sorry, and I appreciate you sharing that. I'm sorry to put you through it. I was very struck in reading your annual report that at the end of the letter, I mean, you said she deserved more joy in a life filled with not enough of it, and she'd obviously had a very hard life. But then I was also really touched by a part where you were saying, I'm not sure dedicating an annual investment letter is a thing. I do want to say, in the spirit of my mom, don't let a day go by that you don't work on relationships with those closest to you. Let them know as often as you can how much you love them. And then there was a really beautiful thing towards the end of the letter where you were talking about a friend of yours who you mentioned before, Jeff Goodall from the Marines, who is obviously a big, tough, 6'4", 295-pound guy who said is beating the hell out of cancer at present. And you said he was someone who would always kind of stand by you and someone who could never be messed with. And you said, but sorry, Jeffrey, you're now number 2. Nobody protected me like Barb, your mother. And you said her children were her universe, peace. And so I thought it was a lovely tribute. And in the same way that we talked about Mr. Smith before, I wanted to, honor the memory of your mom, who clearly was remarkable in being this sort of staunch defender of you through thick and thin as a child, but also later in life.
Yeah, as a kid, she did. I mean, her life was all about her children, and I think she tolerated a relationship she really shouldn't have been in. And when the behavior got so bad, as an adult, I really worked to try to convince her to not be in the relationship. But there was even a little bit of Stockholm syndrome to it. And if I have any regret about my relationship with my mother, and I haven't thought this fully through, but it'll be that maybe I didn't do enough to get her out of that relationship. But she also you make your own decisions, and family was important to her, as misguided as and as unconventional as this relationship was. Perhaps I could have and should have done more. But she was.
Hey, everyone's responsible for their own decisions, and it's hard with a mother to be the one who's like, "Here's how you should live your life."
Yeah. Yeah, and I tell you, being in hospice in her last days, the people in that world are wonderful, and they saw, they understood what was going on. They knew of the behavior. Her neighbors, in fact, knew of the behavior, and they knew of a lot of what had gone on in her life, and even to the end. And they were very supportive of her, and so she had a little bit of a network. But there were so many good people in her life, especially at the end of her life, in her last 5 or 6 years, neighbors. And then in the last 5 months, certain members of her hospice team that managed to bring her a lot of joy, as I said in my letter, in a world that was devoid of enough joy. And there was even strife at the end, and I won't get into the details. It got pretty ugly in the last few months, but
I'm so sorry.
She endured a relationship that I wish she hadn't gotten into, and I wish she had gotten out of earlier. But I think she did it in large part for her perception of trying to keep, in her mind, what was a family together. And I think she tolerated a lot of badness in the spirit of thinking it was the right thing for her 2 sons.
So I think you and I are pretty much the same age. I think we were both born in 1968, if I remember rightly. And it's kind of, I mean, I in many ways had an easier path than you because, I had 2 very loving parents. Flawed at times, not my mother, but who will be listening to this, but occasionally flawed. on my father's side. And I'm wondering like how you were able to rise above this very difficult childhood, because you've had an extraordinarily successful career. It seems like it seems like your dad was also a tough guy. I mean, I remember you I think writing a story about how he would get you to work during the summer and work incredibly intensely. Like what was it that enabled you not to be messed up by this really difficult childhood, but actually to become a very successful and functional human being?
There's a lot to it. I suppose it was probably a trust thing. I always harbored a little bit of anger toward my mother for being in that relationship in the first place. But I think what evolved of that is the ability to learn how to trust those that deserved it and not trust those that didn't. And maybe that's what lent itself to the approach of the contrarian approach to investing and approaching the written word and the spoken word with a skeptical eye. I mean, it's, it makes you a very guarded person. And it wound up making me very driven to succeed. I mean, I had to channel my energy somewhere. And so in football, I was never going to get outworked in the weight room or in preparation. I'd never got outworked in a practice. Approached academics with similar rigor, although school was very easy for me, and I wished I'd, to your point, studied Greek and some of the classics, but I just did enough to get by. I was an academic minimalist. But then when I approached the academic side, the real academic side, my academic side of investing, I approached it with a vigor because I loved it. But it wasn't what was the taught side from the Booth School. It was, how do you break down a business? And it was the cumulative learning and loving to read financial statements. And so I suppose some of that background always made me driven and very, very dependent upon myself. Very willing to take, I needed to take care of myself and make sure I was okay. But that then lent itself toward who I think I am and how I treat people. And the whole combination of things. I've never really articulated it and gone through it all in conversation. I have clarity in my mind about how things all evolved. Senior year of high school, I lived with friends in their basements off and on. I was ready to be on my own when I was 8 years old, frankly.
And so, I mean, it's clear that your work ethic was a huge part of getting you out of the mess. And I was very struck in your 2020 letter to clients that you said the best investors I know seem to come at investing with a chip on their shoulder. They will outwork you. They will outcompete you. And you talked about Mario Gabelli, his quip of wanting to hire PhDs, but that's standing not for people with doctorates, but who are poor, hungry, and driven. And that was clearly the case with you, that there was always this intensity to you and this kind of fire to you. And it seems to me that's something that when you're coaching kids at football or you're mentoring kids on campuses, that comes up again and again, just this idea of like having a really good work ethic, which obviously got you to be an exceptional football player, got you to be an exceptional investor. Is that fair to say that work ethic has just been absolutely central for you?
Oh, it is. And when the football ended sooner than I thought it was going to end for injury, I had to find something to rechannel my energy. And I'd become so curious about investing already that it absorbed all of my focus, 100% of my focus.
And were you really
so
close?
It still does.
Like, could you have been an NFL player? Like, were you that good and that serious when you were at college before you got injured and broke your foot?
Well, I mean, who knows? That was always the goal and the plan. A good friend wound up, my backup at the roommate, in fact, wound up playing for the Steelers for 3 years. I mean, you have to, first you have to survive health wise long enough to get there. I think had I not been hurt and played and gotten the repetitions, given the work ethic, given some of my just innate athleticism, I was the strongest player in the Big Eight. Lived in the weight room, lived for working out. And I was very quick, and who knows, but I do know, had I played, having watched the game now for a lifetime, and even in those early years, I played defensive line. I think I probably would have been a better offensive guard or a center than on the defensive side of the ball in retrospect. When I saw guys like Warren Sapp play the game, Hall of Famers, dude, no way was I ever going to play on that level. That just size mixed with athleticism, mixed with raw meanness. I was very mean. I think you have to be in the football world. You have to be a little mean, but a guy like Warren Sapp he played at a different level. So, I would have been one of those. If you know how pro football works, you hit free agency at 3 years. You don't get paid anything. I think the league minimum when I was a senior, we won the national championship my senior year. I didn't get to play my senior year for the injuries, which took me out the broken foot and the knees.
You also, you once said that when you look back at your high school football coaches and your college football coaches, you said everything I learned from those guys carries over to the investment arena. What are you thinking of when you think of the stuff that really applies from your football days that's really helpful?
I think it's the dedication to the process. It's the dedication to practice and the work that goes into it. But the other takeaway is I think the interaction with people. I think it's this cultivation of my friend network. I owe a lot of how I think and how I approach the world to being able to spend time with my good friends. We have a group that gets together once a year here in St. Louis. We spend 3 days and get through 10 or 12 ideas. These are all marvelous investors and analysts, but they're all kind people. I go back to my first my first football coach when I was 8 and 9 years old, a gentleman named Ken Acker. And I know I told this story on one of the podcasts with Patrick O'Shaughnessy, but he was driven. He was probably my age, and I thought he was really old because I was 8 and 9 years old. But he wound up being so supportive, and as I evolved in my first 2 years of playing to be a very, very driven player in practice, and my love for the game exploded. We had a game that we lost against Columbine, which is the Columbine with the high school, but that's a Jefferson County school. We lost a game against some of those guys who became friends later in life, but we had a good football team. We had some really good football players. Turns out on that little league, our Vada midget football team, we lost a game, and I played my heart out. In retrospect, I think I blocked an extra point and a punt, and I'm thinking, why at that age is anybody kicking an extra point and a punt, having coached little kids later in life? Only bad things can happen when you kick the ball when you're 8 years old, 9 years old. But I was pretty down after the game, and in a setting, he didn't have to do this, but he saw that I was down, and in a setting of all of my teammates and all of the parents, and you're having your Pepsi and your Coke, whatever it was, after the game, which we got. He came over and put his arm around me and talked at length about my character and passion for the game and how I played the game. And that message, boy, oh boy, that at that moment, that kindness from that man changed who I was.
Really? How so?
I just thought, he makes you feel that it made you feel that important and that good. And I thought, what a way to treat other people. And even at that early age, that lesson of how to treat other people I think became hardwired in my DNA.
Yeah, I think there's something really inspiring when I look at your career and I see, this trajectory where you came out of a very difficult beginning, and you made a conscious decision about the type of person you wanted to be. And I don't know, it's interesting. It's also really nice to see the amount of pleasure you get from mentoring college kids and business school students and people through the CFA Society, that I know you've played an important role in. But also, kids' football teams and the like, really giving back over the years.
Yeah, and I think I think about this image, I suppose, that's developed by my being on Twitter, and what I've done a little bit with that platform, rightly or wrongly. But I've chosen to take the abusers of the retail investors, the charlatans. When somebody tells her constituents on TV that you're going to make 40%, then 50% a year, and if I call that behavior out, I think there are a lot of people that think I'm probably quite a bit of a jerk. And I was just at John Mikhailovich's conference in Switzerland early month, and one of the guys who only knew me, I think, from Twitter, put out a picture of three of us, and his comment was, "Spend time with Chris, and he's remarkably a very nice guy." So,
I think a sense of righteous indignation about people being abused, lied to, deceived, and I don't know. I think it makes a lot of sense psychologically, given what you came through, and I think you've harnessed it in a really powerful way, because there is a lot of deception and, as you put it, charlatan promotion within the investment industry, and this is people's life savings. I mean, it's blood money for a lot of people, and so I tend not to call people out, because I'm sort of a repressed Englishman, and also because I don't want to be too judgmental of other people. So because I think it would invite judgment of myself. And so I tend just not to interview people who I think don't have great integrity. So I try to shine a light on the people who I think are impressive and are good role models and are people we can learn from. But I applaud you for the fact that you take a stand and that you call out these inconsistencies, because you have the actual granular knowledge to be able to point out the inconsistencies. And I was very struck when, again, I don't really want to be disrespectful of individuals, but I think of someone like Chamath Palihapitiya, if I'm pronouncing it even vaguely correctly, who obviously is a brilliant guy. I remember once seeing him at a conference, and being like, God, this guy's smart, but at the same time, a brilliant promoter. And when he was starting to say that his returns were better than Warren's, your takedown that actually kind of analyzed the distortion of the returns and was very powerful.
Yeah, and I think it was necessary. Not that the Berkshire record needed defending, but it was the comparison was so maligned and so unethically done that I kind of reflexively, I never would have even heard of the guy had he not made the comparison, and I'd seen the comparison, and wound up he'd done it a few times. In his most latest iteration on Twitter, somebody brought up his comparison to Berkshire, which he claimed to have never made, which is extraordinary. So
yeah, I don't think it's so much about maligning Chamath, who, as I say, I was impressed at how smart he was when I was just listening to talk. He's a smart, charismatic guy. Or Kathy Wood, who I've never met or interviewed, but I'd like to interview her one day. I think she's an interesting phenomenon. It's more about reminding our listeners that you've got to be really careful. This is an industry where there's a lot of misalignment of interests and incentives. And if you can align yourself with people who actually have good ethics and who aren't overcharging you, and even you think back at your first investment all those years ago, college, I think the commission was 10%. It was kind of a pretty good introduction to the casino aspect of of Wall Street. And so I don't know, if there are messages for our listeners to take home, one of them is you've got to be diligent about things like price and valuation, and you've got to really assess whether the people you're getting in bed with have integrity or a record of not looking out for their shareholders and just being promoters. You can't take this stuff on trust.
No, you can't. And in the latest chairman's letter out of Berkshire, and even the last several, I mean, Warren has said, essentially, we have deserved trust over all these years. And, we have owners who have trusted us for this long. And so in essence, he was saying, you can trust us, but it's such a hard thing trying to figure out, who the charlatans are and who the promoters are from, who's legitimately doing it the right way is so difficult for the ordinary investor to ferret it all out. And with attention spans being short, I'd like to say most people spend more time analyzing what their next car purchase is going to be than they do who's going to shepherd their capital for the next 30 years. But you're not armed with the tools to analyze either whether, how to go about investing for yourself or how to allocate the allocation of that capital to somebody else, which is why I think Warren says the default of the S&P 500 for the typical investor that doesn't know what they're doing is such a suitable thing to do, because you're eliminating the frictional costs of fees and you've got a diversified portfolio. And Charlie would beg to differ and say, well, I think Berkshire's better. He might say there are active managers that are better, and there are, but how do you go about finding them? Today, you've got, again, such a concentration at the top of the market, 30% in 7 names, that group trading at well north of 30 times earnings today, it becomes dangerous. And so, if you're the family that's just starting out on a biweekly saving plan through your 401k and you overpay for your first S&P 500 shares, that's okay. If you have a determined, regimented, consistent saving plan over a lifetime, you're going to wind up eventually getting some shares that are reasonably priced, some shares that are undervalued. But if you have real money today and you've backed into these high price to sales businesses that are pricing almost too much perfection, pricing in the implausible outcome, especially now with some of these bigger businesses, even Apple, that's now 50% of the Berkshire portfolio. Warren's kind of cornered himself into the box of, well, it's become a never sell. Well, it's half and it's 33 times earnings. And you've got a big business, doing sufficiently large number of sales revenue that the thing can't grow much more than maybe a high single digit on a earnings per share basis after share repurchases. And so, he acknowledged later in the game that Coca-Cola probably should have been sold when it traded at say 50 times earnings. So, I hope there's a price at which an Apple position might be trimmed, because the economics of what you can earn out of it, even on a net of 21% corporate tax rate basis, now, would justify a trimming of the position at least. He did trim the position a couple of years ago and then regretted it because the stock did so well and the business did so well. But I mean, there's a price at which anything ought to probably be trimmed or sold, including Berkshire. I mean, there are prices at which I would sell down my Berkshire position, especially from an opportunity cost standpoint. But I'm going to do it tax efficiently. I need to have as much after-tax proceeds available to buy my best idea at the top of the opportunity cost stack to justify that shave to the government. And so there are nuances between taxable money and non-taxable money, but it's a really hard game, and it's not easy, but it requires constant thought, constant worrying, risk management. And I think probably if you took some similarity to most of the great investors, they spend a lot more time thinking about what's going to go wrong than what's going to go right. And the non-professional investor, and even I think the majority of professional investors, aren't armed with either the psychological wiring that's required to do that, or the temperament for approaching it that way.
Yeah, or the technical knowledge. I mean, you think of, in your annual letter, the 4 different approaches you take to estimating the value of Berkshire. That's an enormous amount of work to break that down. And at the end of 2022, if I remember rightly, I think you said your calculation was that it was basically at around 74% of fair value. It was trading at a pretty generous discount. And your view then was that over the next 10 years, it would outperform the S&P 500. Now that it's had a pretty good run, but also the S&P has a lot of inflated stuff. I know that you update your intrinsic value estimates every quarter, I think, for all of the stocks you own. I'm asking this very selfishly. Should I, over the next 10 years, still feel happy to own Berkshire?
Oh, Berkshire's stock portfolio is up 20% this year. Apple's grown back to where it's now at a record 50% of the portfolio. But the stocks are a much smaller percentage of the portfolio than Coke was when Berkshire was much more of a pure insurance operation than it is today. You take the moving parts of Berkshire, the profitability from the energy business, where the energy business has the ability to retain capital. They're earning $5 billion, retaining all of it, augmenting it with a like amount of debt. But you've got $5 billion there. You've got what's pushing $8 billion from the railroad, earning low teens returns on essentially the capital of the business. You've got another $13 billion coming from the manufacturing service retail group that are earning adequate returns on unlevered capital. $3 billion, let's say, on a regular basis from underwriting, a few billion from the less than the more than 20 less than 100% held businesses. And then whatever you think the equity portfolio is at what's now $370 billion, $360 billion in stocks. That's now a third of Berkshire's assets. Their assets are going to be over $1 trillion. And so all those moving parts of the income streams, Berkshire's less cheap today than it was at year end. The stock's up, 11 or 12% for the year. And so you've basically earned in the first 6 months and a month. Here we are in mid-July. It's probably earned what it should. And it's trading at a reasonable price. I think it's trading at a discount. But if it maintains this 140% a book, and it's a more expensive book today than it was, because again, Apple is so much more expensive. At the year end 21, I had shaved the Apple position in my appraisal by $50 billion. The stock got killed last year. I eliminated the shave. I'd be shaving it by $50 or $60 billion today. But all in all, you have the S&P trading at 21 or 22. Margins have not recovered. I just did my S&P workup and the portfolio workup for quarter end. Earnings at 204 for the S&P 500 are $4 below where they were at year end 21. Sales are up probably 17%. So you've had margin compression from what was probably a peak, but you're paying 22 times what's probably kind of what's still peaky type profit margins, where they're just in all likelihood not going to grow from here. And if you get inflation rolling, it's in decline at the moment, but you may have rolling inflation for the next decade or two, you're more likely than not to get margin compression. I think the best case on the index at the moment is a 5 or 6% return. More likely than not, you'll have periods where it's substantially underwater in the next 10 or 15 years. And Berkshire's a very conservative 10 to 12 if you hold the current valuation constant. And it's a very durable, predictable earnings stream. And so I think Berkshire's hands down an easy bet from a valuation climate like you have today. When everything gets washed out, it's a crapshoot. My advantage, prospectively, in late 08, early 09, when I'm down 20 and the market's down 40, my advantage is less than it is in a period like today when I got a portfolio trading at 9.5 times earnings again, 10.5% earnings yield, which is half the multiple of the index. And I think we've got a better roster of businesses and managers. Berkshire's just a better manager, and on a net, essentially unlevered basis, you're not going to blow yourself up. You'll never wake up with the headline Berkshire Hathaway negotiating with creditors. I mean, they're negotiating with creditors, but it's the one where they're buying businesses because somebody's going bankrupt. It's not Berkshire ever having to worry about the balance sheet. And so I look at it as a bond. It's a business that earns 10 to 12 on equity, that trades at a pretty modest premium to equity. And it's a place where you can make 10 to 12 in a world of low interest rates. And I think it's got some inflation protections built into some of the big moving parts that make it very attractive in the current setting. And we all know that it's not going to do what it did in its first 35 years, but relative to what I think is, maybe a half return of what Berkshire can earn, it's deserving, at least in our world, at present prices, of a big position.
Yeah, I don't know. Everyone always wants to kind of hit the ball out of the park. I kind of put a pretty high premium on survival. I want to get to the finish line, and I always feel like I'm more likely to get to the finish line with Berkshire than with many other things. Like Buffett's emphasis on survival resonates pretty deeply with me.
I was on the phone with a guy yesterday. We were talking about that, the notion of return of capital and return on capital, and not so much yield, but return to par, in the credit world. And you've got so much leverage on corporate balance sheets. The total leverage in our system is still 350% of GDP. Corporate leverage is very high. If we have persistently high, albeit rolling interest rates, if we have a recession, the Fed will be back at zero. They'll be at the next iteration of QE. But we have so much leverage on the corporate balance sheet, and so much of it is short-term and intermediate term, a lot of it coming due in 24 and 25. If you hold rates at current levels, you have a massive hit to profit margins coming, because the interest burden is going to grow from something that was almost non-existent to something that's very real. And so again, if you live below the EBITDA line and not above it, leverage in a world of high and rising interest rates, when you've got to refinance low coupon debt with higher yield, higher coupon debt, will become very problematic in a world that's allowed too much leverage to build up on the aggregate balance sheet. And so being on the unlevered or less leveraged side of things allows for the survival that you talk about.
I wanted to ask you one final thing before I let you go, because I know I'm exhausting our listeners' patience at a certain point. There's a lovely story that I remember hearing you tell. Maybe I read it in one of your annual reports about a golfer, Ellen Port, and she had been teaching, I think, your daughter's high school team, and she told a really wonderful story that gets at a lot of what we've been talking about in terms of choosing the path of integrity while also being competitive and successful. And I wondered if I could ask you just to tell the story, if you remember it, of what happened to Ellen Port, because I know it's a story you've often told to college students.
I remember it well. Ellen was a great mentor to my daughter, and she's a great friend of mine. She and her husband are wonderful people. Very well known in the golf world, but not known at all outside the golf world. Ellen took up the game of golf in her early 20s. She was a great athlete. She was a tennis player, but grew up around the golf course, but never played golf competitively. And she took up the game in her adult life. And she was a teacher, but took up the game of golf and wound up over all these years. She's now, I won't tell you how old, but she's, easy. Ellen took up the game at such a level with local instruction. She started winning some local tournaments, and she went down and worked with Hank Haney and didn't have the money. And Hank was very good to her and just saw the drive. And at a point told the Oklahoma State men's golf team, that lady up on the hill, how many of you were here on the driving range at 6:00 this morning? Well, she took golf balls into her cottage because she wanted to get out before my lesson and get 2 hours of work in. He says, now, how many of you were out hitting balls before with Ellen in the morning? Nobody, of course. So Ellen, in the meantime, has now won 7 USGA championships as an amateur golfer. And she's like right there in the top 4 with Jack Nicklaus, Tiger Woods. She's won, I think, 3 USGA women's mid-ams and 4 senior ams, and she's still playing golf at a highly competitive level. So she's played on Curtis Cups. They just introduced a couple, 3 years ago, the Women's Senior Open. The men have always had a Senior Open. The women have not. So they started playing that. She was 3rd on the leaderboard a couple of years ago, playing in the group right behind Annika Sorenstam and with all these great professional golfers. Again, she's an amateur golfer. But she was honored to coach a Curtis Cup. I'm going to say 6 or 7 years ago. The Curtis Cup, for those that aren't in the golf world, we have the Walker Cup and the Curtis Cup, and it's the top amateur golfers on the men's side with the Walker Cup and on the women's side with the Curtis Cup. They play against the top players from Great Britain and Ireland. So it's a Ryder Cup type format at the amateur level with the U.S. against GB and I. Golf is a game of integrity. You call penalties on yourself. It's the rule book has sections on etiquette, and Ellen takes that just to heart. It's who she is as a human being. You talk about Bob Smith being kind and wonderful and all the high level of morality and ethics. I put Ellen on a pedestal on the same level. So Lucy and I were invited to St. Louis Country Club to listen to her talk to the media in a gathering before the Curtis Cup. And she told a story about playing in one of the USGA championships. And I guess she was in, so you play, when you're playing amateur championships, you have 2 medal rounds. There's a field of 128, I think, and you wind up with the top 64 that wind up in match play. And then it plays all the way down. So you've got to win 6 matches to eventually be champion. And it's grueling. So she was in medal play, and I think she was, as she normally was, she was leading the field or not. But she said, every night when she's going to bed, she replays the round of golf in her mind, and try to figure out what I could have done here, what I could have done there. And I don't remember where she was. I think it was one of the championships and at one of the courses, great courses in Michigan. I could be wrong, but wherever it was, she got to a par 3, and she said, "Oh my God, Ellen, you did not par the hole. You made a bogey." And her playing partner didn't. In golf, in match play, and even in medal play, you keep the opposite player's score in your group, and so you rotate that around. Well, they all wrote down 3. They thought Ellen had made a 3. That medal round play wasn't on TV. The scorekeepers that walk with the group, everybody thought she'd made whatever she thought she had made. Maybe she said the score. And the next thing she said was she said the drive home the next day was the longest drive of my life. And, had kids that don't know golf, or what happened? Well, she disqualified herself from the tournament. Nobody knew. It would have been that easy to, move on to the match play round. But she recorded an improper scorecard, which is a disqualification from the tournament, or it was at that time. And so she took herself out of the chance to win, because she's literally, if she wins the 8th USGA championship, I think she's tied for all time at either the professional or the amateur level. And out of that, at that high of a level of a game, just ask the students all the time, look inward as to whether you can do something like that. I think of the world of Ellen, and she's so awesome. And what a proper way to construct your life, to be able to do something like that.
Yeah, I think that's a great note on which to end. It reminds me of a lovely thing that Jason Zweig said to me on the podcast when I was interviewing him, where he said something like, well, more people should say, would I sell this to my mother? And I think that idea of looking inward and saying, yeah, I better not do that is pretty good. And so anyway, I've just really enjoyed chatting with you, and I've learned a lot from studying your writing over the last week, and it's I'm thrilled that we got a chance to talk in such depth, and I hope we'll get a chance to actually meet in person before too long, maybe in Omaha this coming year.
By all means, or sooner.
That'd be great.
I'll be in New York in October, but
great. Well,
let's get something on the calendar. But it's what a treat to be here, and thoroughly enjoyed this conversation, William.
Thank you so much. It's a real delight for me.
Thank you. Cheers.
Take care.
The key to improving yourself is not necessarily to do in one direction, but if you do things that make you more honest, more hardworking, that you take the proper diet, that you do the exercise, you do everything else, your whole body works to improve you. Like I mentioned, the chemicals that you have when you do good and when you do things right.